Hello all, welcome to BCCA. This is Manideep, CA and CMA. The most awaited IDT marathon which you are asking has come up in a different way this time. By spending this 5 hours of time, you could easily get 25 marks from GST. Don't do the usual mistakes which you do. Sir, again I kept their introduction. So you think like GST introduction, I have listening it from ages and I have read so many times, but this time I have come up with something very new, sir. This is not the way how you expected, how you have studied. It was completely new. The problem is like when institute is asking 14 marks from a single chapter which has only 6 pages in my material, only 6 pages in my material, but still we are getting 14 marks and still student is not able to get 10 marks out of 14 marks. The problem which I identified is like the answer you write and the answer institute is expecting are not matching. So that's why I changed my perspective. I even want you guys also have to change your study plan. That's why I have specifically recorded this one considering you guys. And I don't want you guys to do once again the same kind of mistake. And I want damn sure you should get the 12 marks from that 14 marks from the first chapter. So what I did means I have taken the suggested answer questions, mock test paper questions which were there from first chapter. So altogether we got some 8 questions only, sir. So those 8 questions related only I have discussed here along with the first chapter, the basic theory, some other, not majorly also, only few points only which were out of those 8 questions. That alone I have covered in introduction chapter. Customs are end to end I have covered elaborately. If you are a student who feels like I don't know properly customs and all, this is one thing which gives you proper clarity regarding the customs at CMA inter syllabus. If you are a CA inter student also, if you are struggling with customs, then this thing will definitely help you. Okay. And for the introduction chapter, whatever the mock test paper questions I have discussed, that would be available in BCCA app under the free resources. There are some 7 to 8 questions which have been identified by me and I discussed them line to line, sir. And I'm again, once again telling in the beginning itself, yes, it feels something new listening or reading that content at this point of time, but it's worth spending that time to get those questions. And you already know that GST only majority students what they'll do, sir. All the 3 GST questions they'll attempt. Out of income tax 4 questions, they'll attempt only 2 questions. Majority will do the same thing, right? When you're doing that thing, when from introduction chapter it's a theory questions, and from theory if you write a part answers or whatever you remember from classroom, you will not get full marks, sir. You'll end up getting 2 marks, 2.5 marks for a 7 marks question. If you don't want to do that, if you don't want to be in such kind of situations, I definitely suggest watching and spending this time. And I wish you all the best. And if you really like the content, don't forget to like, share, comment, and put your location from where you're watching this. Hello all, welcome to customs. Just like as we discussed the GST, even the customs also going to be crisp, cut short, and which is very much useful in your last days of preparation. Okay, so when you look at the weightage of customs, the customs we are having is 7 marks problem. We'll get, for sure there will be a 7 marks question, and then there will be 2 MCQs from customs. 2 MCQs now, each one is for 2 marks, 2 into 2 4 marks. The content which is required for MCQs is already discussed. It's already available in our YouTube channel itself, so you could follow the MCQs. So in this video again, I don't want to gonna waste our time once again considering the flow in MCQs perspective. Okay, just we'll go ahead and we'll try to close as fast as possible considering it only from the perspective of doing problems. Okay, I'll discuss only which is relevant for the solving the problems. Hope you understand my point. Now coming to customs. So customs for CA students, this is something very interesting. You could, okay, if you're a CS student and writing CMA intern now, you don't have any CMA related coaching. So this 2 hours of customs related explanation and solve the problems, you are absolutely fine. You could write this 7 marks question, and following the MCQ session, you could even answer those MCQs as well. Okay. Now customs. So customs is an ancient taxation law than compared to that of GST or any other indirect taxes. Okay. the custom has been introduced initially during the king's era. The people from other countries used to come. So if you see, like Columbus discovered USA, Vasco da Gama discovered India. So like that, there are many people who have discovered many places. So these are like initially they are the people who used to travel and find new places. Once they find a new place, then what the second step will be like, they used to come to our places frequently and they used to trade na. They'll bring something which is precious or valuable or which will not be available in India from their countries, and they'll take it to our kings. Our kings and queens, by looking at that, they'll be amused because there are some things which are not available in India. So they'll give some of the part. Let's say a guy brought some different kind of leather handbags or such kind of things. He brought some 50 bags. First he'll go to the queen and tell like, queen, these 3 bags are for you, or these 5 bags are for you. These are specially made, specially crafted, and once you carry these things, you'll be elegant. Like that, he'll be giving some part of the goods which he brought from outside India as gift to that queen or king. So it has become a practice over a period of year. Whenever a trader from outside India coming to India, first he'll go and approach the king, and from the goods or items which he brought, some items initially will be given to the king or queen. Then the king or queen, they'll get that high moments na, like once they get the gifts and all, they'll feel happy. They say, tell like, okay, the other goods you can go and sell to the people in the kingdom. So like that, it has started, it has become a practice. Like from the goods which were brought from outside India, a part of goods has to be given to the king. But years passed on. Now there is no kingdoms, there is no kings. Now it's only government. If it is government, who is the king? Who is the queen? Does the king and queen can take a part of the goods? No, it's not possible. Government means democracy. We are following democracy. We are the kings. Then to whom? If I am the king, I'm not only the king. There are other 120 crores people also. All of them are kings only. So then who has to take? Then instead of taking a part of the goods, then the government has made it as taking a part of value of the mass. Okay, part of the value. Let's say 100 crores is the total value of import which was brought into India. Out of that, a part will be taken. Let's say 15%, 20%, like that. Out of the value, a part will be taken. Since it is a practice which is coming from over a period of time, over the years, it has become a custom practice. Okay, so that's why it was named as what? Customs law. Okay, so customs law is mainly levied or applicable on imports and exports. You might be having a question, what is called import? Import means bringing goods from outside India to India is called as import. Taking goods from India to outside India is called as export. I'm repeating once again. Import means bringing goods from outside India to India is called as import. Taking goods from India to outside India is called as export. Okay, so see here, entry 83. Sir, to frame any law, we already know in the introduction GST part itself we have learned this. To frame any law, the government should have power which is coming from constitution. So constitution gives the power to frame laws. Okay, now in constitution, in article 246, there's something called schedule. In article 246, there's something called schedule 7. In schedule 7, there are 3 lists. In article 246, there's something called what? Schedule 7. Article 246. In this, there is something called schedule 7. In this, there are 3 lists. What are those 3 lists? Union list, state list, concurrent list. This union list is also called as list 1. This state list is called as list 2, and this third list is called as concurrent list. Union list, state list, concurrent list. Okay, now entry 83 of this union list. Okay, in this 80 union list, there may be so many other items also. On them, okay, sir, understand, if it is something mentioned in union list, on those items, on those activities, central government can levy, central government can frame laws. If it is something mentioned in state list, on them state government can frame laws. Concurrent list na, those are some items on which both central has the power to frame laws and even state has the power to frame laws. Okay, so in union list, sir, understand, if it is related to tax, then it is obviously like when it is mentioned in union list, then the power to frame law and the power to levy tax is with central government. So customs is levied by central government. Entry 83 of the union list of 7th schedule of article 246 of constitution of India gives the power to central government to frame laws with respect to customs. Okay, customs was enacted in the year 1962. So customs is not a single act which are going to discuss here. Customs is of two acts. One is Customs Act 1962 and the other one is Customs Tariff Act 1975. One is Customs Act 1962 and the other one is what? Customs Tariff Act 1975. So you should understand what is called tariff. Tariff means rate. The word meaning tariff means what? I mean, the word tariff means what? Rate. Tariff means tax rates. So whatever are the customs duty rates applicable on imports and exports of different goods, those rates are mentioned clearly in Tariff Act. So if you want to understand customs law, when it is going to be levied, when it has to be collected, how it has to be collected, how it will be verified whether you paid correctly or not, all those related content will be there in Customs Act. But the rates, okay, let's say I have imported a laptop, the value of that laptop is 1 lakh, but on that 1 lakh, how much percentage we should levy as customs duty, that would be mentioned in the Tariff Act. Okay, few definitions, sir, quickly. First one is what? Adjudicating authority. What, sir? Adjudicating authority. Adjudicating authority means the authority which is competent to pass an order or take a decision under this act. Okay, the one who has the power to pass an order or to take a decision is called as adjudicating authority under customs. But just because they have power, everyone cannot be called as adjudicating authority. These three people whom we are mentioning here cannot be called as adjudicating authority. For those, CBIC, the Central Board of Excise and Customs, sir, this is previously it is CBEC, but now it is changed to CBIC. That means Central Board of Excise, not. It has to be called as what? Central Board of Indirect Taxes and Customs. Central Board of Indirect Taxes and Customs. Then Commissioner of Customs Appeals. Then CESTAT Tribunal, Commissioner of Excise and Service Tax Appellate Tribunal. So these three, even though they have the power to take a decision, pass an order, but they cannot be called as adjudicating authorities. Adjudicating authorities, the officer who could verify the documents which we present at the time of import and export and will be granting approvals and will be taking a decision and passing an order. So that guy is called as what? Adjudicating authority. Then assessment. Sir, assessment is of multiple types. Let's say an importer, when he is initially doing the import and all, he'll be filing documents and he himself will calculate his import duty. He calculating himself the import duty is called as self-assessment. Sir, himself, don't take it literally, like he should only learn customs and calculate. He can take the help of like the consultants like us and we'll be calculating on behalf of him. That is also called as what? Self-assessment. When I'm calculating my tax, then that is called as self-assessment. When the department comes and calculates, it is called as assessment. Once it is already calculated, after 1 year, 2 years, again they want to verify. First I calculated self-assessment, they verified assessment, they want to re-verify, then that is called as a reassessment. In sometimes, like I am unable to calculate how much tax will be and all. Okay, so I approached the department side, like I'm unable to calculate, please help me. So they were also not sure what tax rate has to be taken, how it has to be calculated and all. Then for the meantime, they'll do some kind of calculation that is called as provisional interim. For the time being, if they do something, that is called as what? Provisional assessment. So assessment means determination of dutiability. Understand the definition, sir. Just first thing is like find out whether it is taxable or not. Assessment means determination of the dutiability. First we'll find out whether it is taxable or not. If it is taxable, then find out the amount of tax, fees, cess or any other amount payable. Two things only, sir. Finding out whether it is dutiable. Dutiable is nothing but what? Taxable only. Finding out whether it is dutiable or taxable or not. And then the second step is like If it is dutiable, find out the amount of duty, tax, cess, fee or any other amount payable under Tariff Act. Means determination of dutiability of any goods and the amount of duty, tax, cess or any other amount say payable, if any, under this act and even under the Customs Act, considering. Okay, while doing this process, you should consider tariff classification. Why? Tariff classification only consists of tax rates. So, okay, I consider tariff classification. Then value. Why value? Because on value only you should apply this percentage, na? In tariff classification, for laptops it is given as 12%. Then on laptop 12%, now on laptop height you will levy, weight you will levy, on what? Laptop value. So value is important. Next, third one. If any exemption or concession is available for it, if any exemption or concession is available for it, you should consider that exemption or concession. Then you should consider the quantity, weight, volume as well. Sir, why quantity, weight, volume? Previously you said value is only important, na? Yes, but there are some goods. For example, crude oil. We'll import crude oil, na? On crude oil, will not levy duty based on the value of crude oil. Will levy based on the quantity. For 1 liter, 10 rupees. So if you import 1000 liters, then 1000 into 10. 1 lakh liters, 1 lakh into 10. Like that. Okay, and even on cigarette and all, the cigarette will be on import of cigarettes, the duty will be levied based on the length of the cigarette. So at some places value is relevant, at some places their quantity, weight, volume, measurement, those are also important. So that's why it also has to be considered. Then even the origin of such goods, from where they are coming, from where they are coming. Sir, why origin is relevant? Origin is relevant because if the origin is from a country which is a friendly country to India, friendly country, na? With some countries, India has preferential agreements, friendly country agreements. So, if the goods are originating from such country, will levy customs duty at a lower rate. So, that's why we should even know origin. So, assessment means it's not just finding out dutiability and finding out the duty, taxes, fee payable as per Tariff Act. It even should consider tariff classification, value, exemptions, concessions, if any. And the fourth one is what? The quantity, weight, volume, measurement. And even the fifth one is origin. Then that is called as what? Assessment. Then bill of export. Bill of export. Sir, you should remember these two things, sir. Again, don't forget this. Bill of export, or it can be referred as even shipping bill. Bill of export or shipping bill. So these two terminologies. Okay, pause for a while and try to remember this. And then bill of entry. Bill of entry. Bill of export or shipping bill is a document. Okay, this is a document which we present to the customs office to permit our goods to export. Okay, to send our goods or to export our goods, we need a permission, approval from customs office. That approval will ask in shipping bill or bill of export. So shipping bill or bill of export is related to export. Whereas bill of entry, we already imported our goods. We should take the goods from customs port. Then you should file what? Bill of entry. Bill of export or shipping bill is related to export. Bill of entry is related to what? Import. Okay. Then coastal goods. What are called coastal goods? So coastal goods, now let's say this is India. Here there is one place, here there is one place. Now the goods are being coming from this place to this place via ship. Now the goods origin and here it is what? Destination. The both origin and destination is in India. But during the transportation, these goods may go outside India and again come back to India. They may go outside India and again come back to India. Okay, these goods are not imported goods because their origin and destination both is in India. They have to be treated as like what? Coastal goods. Okay, then India. So what is the definition of India? So India means not only the Indian land, it even includes its territorial waters. Territorial waters, now the territorial waters extends to 12 nautical miles from appropriate baseline. 12 nautical miles territorial waters. Then exclusive economic zones. This red color dotted line is there, na? Assume that as exclusive economic zone. This exclusive economic zone is 200 nautical miles from the baseline. From baseline 12 nautical miles territorial waters, for 200 nautical miles it is exclusive economic zone. So Till territorial waters, we call it as territorial waters only. Till exclusive economic zone, we call it as customs waters. So Indian customs waters extends up to 200 nautical miles. Very important for MCQ. Indian territorial waters extends up to 12 nautical miles, whereas Indian customs waters extends up to 200 nautical miles. The sea beyond this 200 nautical miles is called as what? High seas. Beyond 200 nautical miles also, the sea will not end, no. The sea will be continuing, the ocean will be continuing. That is called as what? High seas. High seas. Next, dutiable goods. Dutiable goods, na, goods which are, sorry, by looking at the word dutiable, with basic English itself, you can understand this is a future sentence, not past or present. It is what? Future. So future na duty yet to be levied. Okay. So on these goods, we can levy duty. We can levy duty, but not at paid. Such duty is not at paid. So now export. What is export? Export means taking out of India to a place outside India. So export means it's a process. Okay, taking goods from India to a place outside India. Import means bringing into India from a place outside India. From outside India, bring them to India. Import. Then conveyance. What is called conveyance? Conveyance is nothing but the mode of transport, sir. To do import and export, we should require some mode of transport, na? That is called as conveyance. It could be vessel. Vessel, na? Ship, aircraft, ship, boat, arch, all these will come under what? Vessel. Ship, boat, arch, all these come under vessel. Then aircraft. Aircraft, na, planes, helicopters, all those. And then any vehicles, including train, trucks, trains, all this. Okay, roadways, airways, waterways, all the three covered. Then person in charge. Person in charge, na, for a conveyance coming to India or going out of India, there are some formalities to be carried out, like filing some documents and all. So for that, a person has to be made responsible. So that person who will be made responsible is person in charge. So person in charge for a vessel is master. Person in charge for a vessel is master. For aircraft, it is commander or pilot in charge. For train, it is conductor or guard. For a vehicle, it is driver. For vessel, it is master. For aircraft, it is commander or pilot in charge. For train, it is conductor or guard. For vehicle, it is a driver. Then goods. So the goods definition in customs is quite different from GST. In GST, once again, for you to recall it, good means every kind of mobile property. It includes and as excludes. First, exclusions. Goods means every kind of movable property. Sir, I am referring GST 1. Mobile property. It excludes money and securities. Money not a good, security not a good. But includes growing crops, actionable claims, grass, and things attached to the land. Even though it is attached to land, it can be called as good, but it should be separated before making supply. It should be separated before making supply. So the term goods includes here. Look at it in a different perspective, sir. Goods even includes vessel, aircrafts, and vehicles. I mean, the conveyances can also be called as goods. And stores. What is called stores? Sir, in ship and all, okay, it should carry spare fuel, spare parts as well. Because just like as our bike or car, when there is some problem, we cannot keep aside and we cannot ask someone to come there. Because in mid-sea, nobody will be there to help you. Okay, if you are out of fuel. So that's why they'll be having spare fuel, spare parts for all the machines, components and all. So all those are called as what? Stores. Then baggage. Baggage is nothing but the luggage carried by the passenger. Okay, I went to Dubai and coming from Dubai. Okay, the luggage which I am carrying while I am coming from Dubai is called as what? Baggage. And even currency. Sir, money is not a good under GST. But as per customs, it is good only. Even negotiable instruments are not goods as per GST, but here they are goods. Okay, so understand. The term goods includes vessels, aircrafts and vehicles, stores, baggage, currency and negotiable instruments and any other kind of movable property. Fine. Then this case law is not much relevant, sir. This one only. Sir, intangible assets like the songs, music, the movies, designs, arts, these are generally intangible assets only. But the moment they kept into a media, like a song, once it is kept into a cassette, once it is kept into a CD, DVD, or any art technical advice, they're actually intangible assets only. They doesn't have any physical form. But once they are kept into a media such as like a paper form, hard disk, pen drive, floppy, okay, then they are called as what? Goods only. Next, prohibited goods. Goods which import and export is prohibited under this act or any other act. So this is important. That good need not to be prohibited only in customs. Even in any other act it is prohibited also. It is called as what? Prohibited goods. Example: pornographic and obscene materials, narcotic drugs and psychotropic substances, wildlife product, specified live birds and animals. Okay, pornographic, obscene content, narcotic drugs, wildlife products, specified live birds and animals, wild animals. Okay, all these are called as what? Prohibited goods. Then DTA. So to understand DTA, sir, within India, okay, within India, there is something called SEZ. SEZ. The full form of SEZ is Special Economic Zone. Special Economic Zone. These special economic zones are notified by central government. Notified by central government. Sir, in this SEZ, there will be concessions. Tax waivers will be there. That means there will not be any tax once you start a unit there. And the rates, the tax rates will be less. The government will freely allocate land, may freely allocate land, may provide electricity at lower rates and all. The cess are spread areas. In these areas, if you start your industry or unit, you will be having a lot of advantages, but they'll not easily give you permission to start your unit in SEZ unless you are an exporter or majorly you do exports. You understand point? Okay. Now, this says has to be treated as separate from India. Even though it is within India, you should treat it as a separate island. This says as what? A separate island from other than India. You should not treat as a part of India. So security wise, it is India only. But for these taxations and all, you should not consider them as India. So if this is cess, then the tax rates applicable in cess may be different. Okay, you understand na? Then the rest of cess, only if this is cess, the rest of all this area is called as DTA. DTA na domestic within the country, domestic tariff. Tariff means what I said, rates area, domestic tariff area. So domestic tariff area DTA na. So the part of India where the actual customs duty rates are applicable. If it is SEZ na, it might have relaxations and not the actual customs duty rates are applicable. Some concessional rates would be applicable. So DTA means the whole of India, including the territorial waters and the continental shelf, but does not include SEZ and EOUs. Understand? Okay. Then come back here. Charging section. What is the charging section, sir? For every act, there is one charging section. What is the role of charging section? Charging section gives the power. It's the power supply to the whole act. If you remove charging section, then there is no fuse to that particular act. So it cannot work. So charging section gives the power and it tells when the tax has to be triggered. When the tax has to be triggered. On doing what, it has to be triggered. So what is the charging section says? Like as per section 12 of Customs Act, import and export. What? Import or export of goods into India. So what is the charging act, sir? Okay, for living tax, something has to be done now. Just you're eating, sleeping, eating, sleeping, eating, sleeping. Will any tax will be there? Sir, in my room only. I'm not going anywhere. I'm just eating, sleeping. For eating and sleeping also you will levy tax. No, right? So what you should do to get customs attracted? You should either import or export of goods into India. So this is the taxable event. Taxable event for payment of duty of customs as per such rates in the customs tariff. Okay. Now the next question is, what is import? What is import? Sir, you already said na, sir. Import means bringing goods into India. Why, sir? Again you are asking. Okay, you might have memory loss. We don't have memory loss. Like that, some student might comment beneath this video. Okay, but understand, sir. Import means, understand. Okay, sir. I'm going at a good pace only. So whenever you feel I'm going at little faster, you can use the YouTube settings now. That you could lower the speed, you could increase the speed. Everything is with yourself only. So that you can do. Sir, this is customs waters. This is territorial waters. And this is Indian land. Now, ship coming from outside India. Titanic. Okay, here Jack Rose are there. The two are standing like this and they are waiting to come to India. This is what Titanic. Now the question is, customs waters are up to 200 nautical miles from Indian baseline. Territorial waters are up to 12 nautical miles. So import means we know from outside India, if goods are coming into India, this is called as import. Now, import means once the goods touch territorial waters, import completed. Or once they touch customs waters, shall we refer it as import completed? Or shall they touch Indian land massa? Sir, import is a process. When the goods cross territorial waters, when the goods cross territorial waters, so here import started. Here import started. And it continues. It continues. Ship came till the port. Then also it doesn't end. Ship came here. Okay. But from here, when the goods are unloaded, these are the goods. Goods are unloaded. So only when the goods are unloaded and the goods form part of land mass of India, I mean they will touch the land, then import completed. Import starts here and import completes here. So import is not a one-step journey. Import is a process. It starts when the goods cross territorial waters and ends once the goods form part of Indian land mass. Okay, so from here it starts and it continues. Here the port, the ship went. Here the maybe waiting for unloading. Still import not ended. Only when the goods are unloaded and they form part here, then the import is completed. Sir, then what if there are some places, sir, customs waters and between two territorial waters there is so much seen. Here there may be some oil rigs. Oil rig na, they'll extract oil from there within the sea. From there they will be extracting oil. So the goods came from outside India, but the goods directly unloaded here and they started using the goods there itself. Is it import? Yes, it is also import. A case study said like, okay, even though they didn't enter into territorial waters technically, but if they are being consumed within the exclusive economic zones, within the customs order, it is import only. There they said like, territorial waters even includes customs waters. Territorial waters even includes customs water. But understand, sir, that is a specific case. Let's say, will if we import 100 different goods now, maybe one good might be consumed in exclusive economic zone. All the others will be consumed where? Within the landmass only. Na? So this one, which I said initially, is the regular definition. Import is a process which which starts when the goods cross territorial waters and ends when they form part of mass of India. I mean, when they touch land mass of India, then the import is completed. But in some exceptional cases, goods may be consumed within the exclusive economic zones itself in the oil rigs. Then it also has to be treated as like what? Import only. It also has to be treated as like import only. Clear, sir? Now, before going further, we should understand the process of import. Only when we understand the process of import, we can proceed further. Okay? So very easy only, sir. Very easy. Just focus with me. Here, this fellow is there, na, wearing suit and all. He is called person in charge. Who is called person in charge, sir? For vessel, it is master. For aircraft, it is commander or pilot in charge. For train, it is conductor or guard. For any other vehicle, it is driver. So this person in charge will file IGM. So what is IGM, sir? We have read law, we know AGM, annual general meeting, we know EGM, extraordinary general meeting. What is this IGM, sir? This IGM means Import General Manifest. It's a name, Import General Manifest. You can even call it as what? Import report. Okay, sir. What will be there, sir, in this? In this import report, it consists of details of the goods as well as passengers who are there in that particular conveyance. In that conveyance, what are the goods they are carrying, who are the passengers, who are the crew members, I mean working in the ship or aircraft, those details will be there. So person in charge shall file IGM before the arrival of the vessel or aircraft electronically. What? Electronically, I mean you should file it online. That also not after, once the vessel arrives, before the arrival of conveyance, the person in charge has to file IGM. Okay, filed, sir, done. Then what this proper officer has to do? This proper officer, after verification of IGM, this proper officer grants entry inward. He'll verify. What he'll verify, sir, in that? He'll verify whether any explosive kind of or any other non approved, I mean prohibited kind of materials, or if anything are carrying in that particular aircraft, or any other passengers or who are mentioned in the, will have some target kind of list and all, na? Governments will have for security reasons. That kind of people, if any are coming out, those verifications they'll do. Once they are convinced, no, this fellow, all these are safe things only, then they'll allow entry inwards. Once entry inward is granted, then the ship arrives at the port. Ship arrives at the port. Then once the ship arrives at the port, then the goods will be unloaded. Understand, sir? When there is no entry inward, no unloading. Only when entry inward is granted, then unloading of goods can be provided. And the unloading has to be carried in the supervision of proper officer. Okay, on a working day, on a working hour, unloading of goods has to be carried at the port only when entry inward is granted. First point, clear, na? With the supervision of proper officer, only when the proper officer is there and in a working hour. Okay, next step, sir, before going here further. On unloading, once the goods are unloaded, the goods will remain in the custody of custodian. So custodian now who, sir? So you know Adani Ports. There is one company called Adani Ports. What Adani will do? They'll take over the control of port. So that port is owned by no Adani. Government will sell the port to Adani. So Adani will take care of the infrastructure development and all, the ports development, everything will be taken by Adani. So the port will be under the control of Adani, not in the control of government. So that Adani ports will be there, no? That is called as custodian. That is called as custodian. So once the goods are unloaded, they'll remain in the control of not government. They'll remain in the control of whom? Custody of whom? Custodian. Custodian is port authority. The one who develops or take care of the port operations is called as what? Custodian. You understand, right? You understand? So for us, quickly, what is the step one, sir? Person in charge files IGM before or after? Before the arrival or after the arrival? Before the arrival. Before the arrival. How? Electronically. So before arrival, and this also has to be filed out electronically. Then step 2. What proper officer will do? He'll grant entry. He'll grant what? Entry inwards. Then step 3. Once entry inwards is granted, then the conveyance, from the conveyance, proper, okay, conveyance, unloading will be done. Unloading will be carried out under the supervision of whom? Supervision of this proper officer. That also when? During the working hours on a working day. Okay, then step 4. What is step 4? Once the goods are unloaded, they'll remain where? Once the goods are unloaded, they remain in the custody of, custodian. Once the goods are unloaded, they remain in the custody of custodian. Okay, custodian is nothing but the port authority who is authorized to take care or to develop, the owner of the port, simply. Okay, then, sir, once these steps are happening, simultaneously importer can do. Sir, simultaneously, sir. What I'll say now cannot be called as 5th step, because this is something which can be done simultaneously as well. So this is one side. If this is happening, then importer na the one, okay, the goods belong to this fellow only. This importer has to file, bill of entry. He has to file bill of entry with whom? He has to file bill of entry with the customs office. Okay, so bill of entry, what it contains are this bill of entry. This bill of entry consists of goods. Which goods you are carrying, what is the tax rate, calculate the tax, duty, and that assessment you will do, self-assessment, and you will file bill of entry. Babu, please let my goods to take. That is called bill of entry. Okay, that is called bill of entry. Now customs office verifies and returns bill of entry, verifies and returns. Once it is returned, immediately pay customs duty. Once it is returned, immediately pay customs duty. Then you can take your goods. So paying duty immediately and taking goods with you is called as home consumption. Okay, understand the word, sir. What I am referring now? Home consumption. Sir, home consumption are taking home and eating. No. That's not home consumption. Home consumption means what? Bill of entry filed, plus tax paid. Sir, I am using the word tax because we are very much used to the word tax, but otherwise in customs actually we should use only what? Duty paid. Bill of entry filed and duty paid. Then the goods can be allowed to cleared for home consumption. It's not that you should only take to home. You can take to your factory or you can take to any of your place. So home consumption means bill of entry filed and duty paid, and they are cleared for what? Home consumption. On payment of duty, if you take the goods with you either to your factory or to your home or to any of your place, then that is called as what? Home consumption. Pay duty and take with you. Home consumption. What is the other thing, sir? There is another thing also called warehousing. Sir, I imported goods but no money to pay duty. You might ask me, why you purchased goods then when if you don't have money to pay custom duty itself, how you bought goods? Sir, I didn't pay money to the seller there. My creditor given me credit period of 12 months. I'll pay him after 1 year only. So that's why I brought the goods now. But customs also no money, sir. Actually, I imported 1,000 tons. Out of 1,000 tons, I have money to pay only for 200 tons. Customs duty, for customs duty payment, I have money only for how many? 200 tons to pay money. Then what I should do, sir? These 800 tons I brought now. So then the option we are having is this 200 tons file bill of entry. Okay, pay duty and take with you. Then that is called as what? Home consumption. Okay, sir, I took this 200 tons. What about this 800 tons, sir? What I should do with this 800 tons? For this 800 tons, you're having an opportunity called warehousing. What? Warehousing. Sir, warehousing means what, sir? Warehousing means this 800 tons also, for this 800 tons also, you will file bill of entry. Sir, I already said, sir, I don't have money to pay duty. Don't worry. File bill of entry for this 800 tons also. Okay, but this bill of entry will be little different than that of the actual one. This is little different. Okay, file this. With this bill of entry, you will say like, sir, I'm not going to pay tax now. I'll keep these goods in warehouse. I'll not use. Promise, mother promise. Okay, I'll not use these goods. Or else if you have warehouse, not tell. In your warehouse only I'll keep. Not in my warehouse. In your warehouse only I'll keep. I'll not use them, sir. Promise, sir. Okay, promise. Done. You'll not use now. Okay, keep there. Keep there. Don't pay duty. Sir, then always free now. No. Whenever I remove goods from that warehouse, I need to pay duty. Whenever I remove goods from that warehouse, I need to pay duty. So understand, imported goods. Okay, these are within the port area. This is port area. In this, imported goods are there. These are the goods. From here, I'll take the goods to warehouse. This is warehouse. Okay, while taking warehouse also, what I'll do? I'll file a bill of entry. But duty paid or not paid? Duty not paid. Understand? Duty not paid. I imported goods into port area. I filed bill of entry. Duty not paid and taken to warehouse. Here one of. Again, while removing from warehouse. Removing. Sir, this is what entry to warehouse. This is what exit to warehouse. I am removing from warehouse. Okay. While removing, again file a bill of entry. Now pay duty. Now pay duty. This is again what? Removal for home consumption. Removal for home consumption from warehouse. This is this bill of entry. Initially when you are taking to warehouse, that bill of entry is called as warehousing bill of entry. Then this is called as what? Removal from warehouse, another third bill of entry. So there are total how many bill of entries, sir? Bill of entry 1, bill of entry 2, bill of entry 3. Bill of entry 1, direct home consumption. You imported, pay duty, take with you, home consumption. Bill of entry 2, no warehouse, no home consumption, sir, I don't have money. So then keep them in warehouse. Then bill of entry 3, sir, I got money. No, I got money. So then file another bill of entry. This is nothing but what? Warehousing to home consumption. Sir, how we could know, sir? This bill of entry 1 is called as nothing but form 1. This is form 1. This is form 2. And this third one is there, form 3. Sir, any other differentiation, sir? Yes. This one will be in white color. This one will be in yellow color. And this one will be in green color. How many bill of entries are there total? 3. White, yellow, green. White for direct home consumption. Yellow for warehousing. Green. Warehousing to home consumption. Warehousing to home consumption. Sir, this process very, very important, sir. Full. Okay? I'm not scolding you. If you forget this, I'll literally, this words remember, sir. Understand? Okay? I'm making it short, but I'm not missing anything which is important. Okay? You understand? I'm discussing fast, but I'm not missing anything which is literally important for exams. I'm discussing everything. So every point which I spoke from my mouth is very, very crucial, important for your exams. Okay? Step 1. You understand the import process now? Come on. Close your eyes. Visualize. Close your eyes. Today, promise on your attempt. You're closing your eyes. Okay. What is the first step? The ship. You're not looking at me. You're just visualizing whatever I'm saying. Step 1. The conveyance. Assume it as a ship. Ship coming from the outside India. Once it comes from outside India, before it comes to Indian port, the person in charge has to file IGM, Import General Manifest. It consists of goods, passengers, all the details. Yes, it is received by customs officer. Now the customs officer has to verify it. Once he is convinced, he is satisfied, he'll grant what? Entry inwards. The permission for the ship to come into India, entry inwards granted. Once the entry inward is granted, the conveyance will come into Indian port. Close your eyes. Okay. Then once the conveyance reached the port, the goods will be unloaded only in the supervision of proper officer during the working hours on a working day. Once the goods are unloaded, they'll remain in the custody of custodian. 4 steps. File Import General Manifest, proper officer verifies, granted entry inward, ship reached the port, goods unloaded under the supervision of proper officer. Once they are unloaded, they'll remain in the custody of custodian. Clear? Now. Okay. For 1 second, you open your eyes and again close. Then importer, after all this process, he can file bill of entry, or parallelly with the steps which I discussed, along with that, importer can do these things as well. Importer has to file bill of entry. While filing bill of entry, we have 2 options. If we have money to pay tax and all, pay duty and take the goods with you. That is called as home consumption. If you don't have money, then what you should do? You cannot keep them in the port itself. Okay, you cannot keep them in the port because the place in port is not enough. So you'll file another bill of entry which is for warehousing. So you'll put the goods in warehouse. Whenever you have money or whenever you have requirement of goods, you will pay the duty and take the goods with yourself. So there are 3 types of bill of entry. Very simple process. You understand now? Hello, buddies. So once, quickly, in detail. When the vessel aircraft carrying goods arrives into India, okay, this is something only the vehicle, the vessel aircraft should come only to the customs station or customs port. They cannot go for sightseeing and all without coming to the port first one. Then person in charge shall deliver IGM electronically before the arrival of vessel or aircraft. However, if it is coming through land route, truck and all, even after arrival also they can file. On receipt of this IGM, proper officer will grant entry inwards. Only it is granted, goods can be unloaded. Next, goods unload. Okay, while unloading is happening, then this proper officer shall let the goods to be unloaded only if they are mentioned in IGM. If there some new good comes in the vessel, you shall not allow. Goods shall be unloaded only if they are mentioned in IGM at a approved place under the supervision of customs officer. Once the imported goods have entered under the customs area, they shall remain in the custody of custodian. For pilferage, so what is pilferage, sir? Pilferage means small quantity theft. Okay, when the goods are kept in the customs premises, some small thieves. Okay, like what? They'll open the containers and all. Let's say it consists of some 100 tons. They'll open little and they'll take some 5 kgs, 10 kgs, 20 kgs. So small quantity theft. Like from a whole rice bag, the small quantity which rat will theft. Okay, they'll put a small hole in 1 day, 2 days. How much rat from a 25 kgs rice bag? How much rat can take? Some 1 kg maximum or 2 kgs within 3-4 days. Okay, that is called as that small quantity theft is called as pilferage. You understand? Next, importer shall file what? Bill of entry electronically for clearance of goods, and which is of how many types? 3 types. Okay, this is one again important, sir. Bill of entry can be filed before the arrival of the ship or aircraft. Before the conveyance comes also, you can file bill of entry. Okay, but once it comes now, within 2 days. 2 days now, how? Next day to the following day. Okay, the next day to the following day. When within 2 days from the arrival of the vessel or conveyance, it has to be filed. Next, importer shall self-assess the duty considering the applicable exchange rate, tax rate and all. For warehousing, payment is deferred till clearance. Home consumption duty has to be paid in prescribed time. Okay, next, within 30 days from unloading, sir, you have to, your goods were unloaded in the port area. From port area, either you pay duty, you file bill of entry, pay duty and take to your home, or you can take them to warehousing. You cannot keep them in the port itself for more than 30 days. If you keep the goods in port beyond 30 days, then a penalty will be levied, which we call it as demurrage. DEMMURAGE, demurrage. Port demurrage. Okay, this is a penalty levied for delay in clearing the goods from port, which we call it as what? Port demurrage. Port demurrage. You understand, right? This is what? Import process. Okay, now understand what is the taxable event for imported goods. Very important, sir. This one, taxable event for imported goods. Taxable event, sir, we understand when customs duty will be levied, import or export. Okay, import, I said, like when the goods cross territorial waters, the import process will start. The import process will start when the goods cross the territorial waters, and it continues and ends when the goods touch the land mass of India. Till here, no confusion. Clear, right? But once they kept on Indian land mass, will the customs officer will go and ask for customs duty? No, right? There is some time. So we are asking about when you should pay customs duty. What is the time you should pay customs duty? So the time is unloading, not a taxable event. So just because you unloaded, you need not to pay customs duty. Unloaded goods, I have still an option to relieve my title there itself. I can say like, no, I don't want these goods. I'll throw these goods here itself and I can escape from customs duty payment. That option is there. So unloading is not the taxable event. Date of entry into territorial waters. My goods now entered into territorial waters. No. That is also not the taxable event. Even after entering into territorial waters also, I can deny paying customs duty. Third one. Presentation of bill of entry. Even after presenting bill of entry also, I can deny payment of customs duty. I can simply say like, I don't want goods, take the goods also, I don't want to pay customs duty and all. But when you are removing the goods from customs barrier, once your goods are crossing the customs barrier, you cannot pay. You cannot deny saying like, I'll not pay customs duty. Once the goods are crossing the customs barrier, it is the taxable event. You are obliged, you are mandatory, you should pay the customs duty. Clear? Okay. This is the intro part, sir, which we discussed. Sir, one theoretical part which I should discuss here is wreck, derelict, jetsam, flotsam. Wreck, derelict, jetsam, flotsam. This wreck, derelict, jetsam, flotsam. All these four also has to be treated as what? Imported goods only. This wreck, derelict, jetsam. All these four also has to be treated as what? Imported goods only. Imported goods only. Now understand what is called wreck. Sir, a part of the ship which came to shore. A part of the ship which came to shore. Part of the ship means what, sir? So the ship was sunk, broken. Out of the ship, a part was came to the shore because of tides and all. That part of the ship which came to the seashore, that we call it as what? Wreck. And you want to take that wreck and take it into Indian, then that wreck also has to be treated as imported goods. Derelict. It is also a part of the ship or full ship, part of ship or full ship which was sunk. Okay, sir, it was not came to India because of this tides and all, tides waves, not because of that. How this sunk, the ship which was sunk was came to India. It was taken by a team. Okay, a team. There are certain companies, sir, which will go and explore these kind of things. Okay, a team went there and they found out the ship and they found out the parts of the ship and all, or they brought the ship and all to reuse them for some purpose and all. So then when it is brought purposefully with an intention to bring, then that is called as derelict. The sunk ship, if it is brought to India, then that is called as derelict. That also has to be treated as what? Import. Jetsam and flotsam. Sir, wreck, derelict is nothing but the conveyance itself. Whereas jetsam, flotsam are the goods which were there in the conveyance. So this jetsam and flotsam, understand, when the ship is carrying so much weight, sir, and there are heavy tides and all, and there's something like cyclone and all. So because of this heavy tides and all, there is a lot of movement in the ship and all. There is such situation, like because of this heavy weight in the ship may get sunk. So to prevent the ship from sinking, certain goods will be thrown into the sea. Certain goods will be thrown from the ship into the sea. So to reduce the weight of the ship. So the goods which were thrown into the sea can be either flotsam or jetsam. Flotsam or jetsam. So again, the same kind of flotsam I thrown in the water from the ship. I have thrown those goods into water. Those goods floating and came to the shore. Flotsam. Jetsam. We thrown with very speed, like they will not be floating. They'll go and sunk in the sea. Will throw with very high speed. So they'll not float. They'll directly sunk into the sea. Then again, a team will go, they'll search for those goods and they'll bring those goods. They are called as jetsam. Floatsamna, which were floated and came. Jetsamna, which were sunk. A team went and again dragged them to the shore. They are called as jetsam. So, sir, you might have a question. Sir, their value might have reduced, they might have damaged. Yes, whatever the value you'll get, that value is leviable to customs duty. These are also has to be treated as what? Imported goods only. Next, pilferage. Sir, pilferage, I already said. Pilferage means what? Small quantity theft. On pilferage, importer will not pay customs duty. Out of 1000 kgs, 5 kgs, there is pilferage. So on pilferage, importer will not pay duty. Will not pay duty. That means on how much value will pay 5 kgs. If you subtract 9,995 kgs only, importer pays duty. Importer pays duty. Then on this 5 kgs loss only. No, on this 5 kgs, custodian, the port authority will pay duty. Okay. So pilferage, if my imported goods, if there is pilferage, I'll simply say like there is pilferage happened. Then it is the responsibility of custodian to go and verify whether the actual pilferage is there or not. It's the liability, it's the obligation of custodian to go and check whether there is actually pilferage or not. You understand? Next, pilferage. Then pilfered goods, these are covered by section 13. No duty payable on such goods. Department gets that on lost goods, who will get the amount, sir? Custodian. Petty theft. Pilferage na, like I say like I brought 1,000 items, but only 995 items are available. So other five times later, custodian will go for an inquiry and all. If he found, he'll be restoring them. Occurrence is after what? Pilferage means it occurs after unloading and before customs clearance for home consumption. Before customs clearance for warehouse. Customs clearance. Okay, either for warehousing or home consumption. Occurrence in warehouse is not considered here. Duty need not to be calculated on pilfered items. No need to prove pilferage. It is quite obvious. Generally it happens. Next, lost or destroyed goods. If the goods are lost, completely lost, sir, not 1,000 kgs, 5 kgs is not missing. The total 1,000 kgs is missing. Or fire accident happened and the total 1,000 kgs was turned into ashes. Then it is covered by section 23. Duty paid on such goods to be remitted. If already duty paid, they'll remit back to me. They'll give it as a refund. No such compensation. Lost destruction is by fire, flood, etc. And restoration is not possible. You cannot bring back them because already fire accident happened and they were turned into ashes. Restoration is not possible. Occurrence may be at any time before clearance for home consumption. Even if it is occurred in warehouse also, there will be remission of duty possible. The duty, if you paid, that will be given back. Duty shall be calculated for determining the remission amount. Should be proved that remission is sought after this. You understand, sir? Then there is something called, sir, here I need to tell something, one more point here. Abatement. Pilferage I explained, na? I should say abatement. Abatement means what? Goods were damaged. Goods were damaged. Goods were damaged. Like, so I brought some items, sir. It has, because of it, they were spoiled or damaged. So I cannot get their full value. Actually, we could sell each product for 10,000. But now this is the damaged product. Will not get the full value. So then we have a chance of getting abatement. Abatement, na? They'll give some kind of discount, kind of 30% abatement, na? It is nothing but we are assuming 30% damaged. Okay, 50% abatement. That means 50% damage. So from the actual value, reduce this abatement and on the balance value, you'll levy duty. So abatement is for damaged goods. Lost, destroy, na completely zero. They turn out zero. No use from the pilferage, na small quantity tough. So there is pilferage, lost, destroyal, and even damaged. This damage may happen even during the transit, while unloading, and before home consumption, before clearance by the customs officer. Okay, abatement, pilferage, loss, destruction, three are different. Abatement when the goods are damaged, lost or destructed, either they'll remit duty, I mean you need not to pay duty. If already paid, they'll refund it you. Third one, pilferage. Pilferage means small quantity theft after unloading, before clearance. Okay, if any small quantity theft is happened, for that pilferage you will not pay any customs duty. Clear, sir? Sir, this is first chapter, sir, which have a quite proper discussion we had. Okay. Okay, don't go away. Stay tuned to BCCA and this marathon only. You're gonna get very useful information. The next chapter we are starting is with types of duty. If you like this video, don't forget to like this video and put a comment here. Okay, thank you. So now coming back to the point here. Now we are entering into the part types of duties. Sir, customs is not a single tax or duty, it's a bunch of taxes or bunch of duties. It's very easy, sir. Okay, even, sir, I am again saying this. You are a CA student, you wrote CA inter, but there customs is not applicable. Now you wanted to write even CMA, but you cannot attend once again coaching and all, but you want some clarity regarding the customs and all. This is damn enough. Believe me, trust me, this is damn enough. See, the problems is like, sir, but 7 marks question which usually asked in exam is combination of types of duties and valuation. The 7 marks sum which they are asking in exam, usually here and there it may change, but majority times it's types of duty plus valuation. Both knowledge you should have. You should have knowledge of both types of duty as well as valuation. Both knowledge you should have. So now valuation, this chapter objective, I mean by doing the valuation chapter, will find out the assessable value of a good which is imported. Will find out what? Assessable value. So if you know assessable value, if you know what assessable value, on this assessable value we need to calculate customs duty. We should calculate what? Customs duty. So that calculation of customs duty is only explained in types of duty. So for the first 10-15 minutes, okay, before going into the material and all, you should trust me in this, and you should do along with me. Take a pen and paper and write along with me as well. Okay, this part. Okay, this is very crux, sir, and these are easy pickings, sir. This 7 marks. Assessable value. Okay. On assessable value, first we levy BCD. BCD na basic customs duty. Basic customs duty we should levy on this assessable value. Okay, first we should levy what? Basic customs duty. This is levied on what? It is given as a percentage on assessable value. The percentage of basic customs duty will be levied on assessable value. Next. Then immediately we should go over social welfare surcharge. Social welfare surcharge. So this is always 10%. This is always 10% on BCD. You should levy, not on assessable value. Social welfare surcharge will be levied on this BCD. I mean on this. Okay, if you take it as 1, if you take it as 2, if it is 3, on the 2, the second point value, you should levy social welfare surcharge. Okay, then there may be something called AIDC, agriculture infrastructure development. Agriculture infrastructure development. This is also as a percentage you should levy on what? Assessable value. As a percentage only you should levy on what? Assessable value. This is the fourth one. Then fifth one, you should add safeguard duty. Or it may be, sir, these are not synonyms. These are different duties, but instead of writing multiple steps, I am writing under the single step. Either it could be safeguard duty or countervailing duty, or there may be something like called anti-dumping duty. Anti-dumping duty, safeguard duty, countervailing duty, anti-dumping duty. Okay, that you will be levying. So how to calculate this? This and all you need not to worry for how safeguard duty, countervailing duty, anti-dumping duty. That would be clearly mentioned in the problem. That percentage you will apply on what value it should be levied also will be given in the question only. We need not to by heart or discuss anything. When we go into the theory part as well, once again, I'll again explain there what is the purpose of safeguard duty, why anti-dumping duty is levied, why countervailing duty is levied. That I'll explain again. Okay, this levy as per question info. Okay, you understood now? Once you levy this, you will get a total. This total I call it as subtotal. I call it as subtotal. So for this, what and all we added the assessable value, basic custom duty, social welfare surcharge, agricultural infrastructure development cess, safeguard duty, countervailing duty, anti-dumping duty. These 5 points you should add. You should add. Okay. Then on this subtotal now will be levying IGST. IGST as per the percentage given. On subtotal you should levy on subtotal. Sir, subtotal it is what? The assessable value plus the taxes under customs. So it's a total of customs plus all the customs related taxes. All this we should add. On this we should levy IGST. Then seventh one, GST compensation cess. This also has to be levied on a percentage on subtotal. This also has to be levied as a percentage on subtotal. Do we need to total it, sir? Of course, you can do, or even if you leave also, no problem. Sir, the question asks, what is the customs duty payable? If the every fellow will do what now, they'll do the total and they'll tell like that is the customs duty. That is utter wrong. Day, why you will pay this assessable value is the good value, ra? The assessable value is what? Good value. Why you will pay this to the customs? You understand now? So this is not the amount we are going to pay. So what is the customs duty payable? For that, customs duty payable equals to 2 plus 3 plus 4 plus 5 plus 6 plus 7. That means BCD you need to pay. BCD, the total of BCD, social welfare surcharge, AADC, safeguard duty. Okay, there is, yes, 2, 3, 4, 5. And then IGST and cess. All this total is what you pay as customs duty. And out of this IGST and compensation cess are there now, these two. You can avail them as ITC as well. So ITC eligible equals to 6 plus 7. So this two total is the ITC, whereas the all 2, 3, 4, 5, 6, 7 total is the customs duty payable. So understand, assessable value, from assessable value, the process of computing tax is this way. Okay, but for you to have better understanding, sir, when they are asking a 7 marks question, usually there will not be AIDC in the part, and they will not link safeguard duty, countervailing duty, anti-dumping duty. So these two will not come regularly. So if these two are not there, then it will be much more easy. Okay, let me take you to an example. Let me take an example and explain you. Then let us take the assessable value equals to $1 lakh. First, assessable value, if it is in dollar value or any other foreign currency, we need to convert it into Indian rupees. So let's say $1 equal to 80 rupees. So then assessable value in Indian rupees, how much, sir? Assessable value equals to 80 lakhs. Okay. First on this, what we should levy? BCD. Okay. Let us take the BCD as 12%. So what you should do? 80 lakhs into 12% you should do. How much it is? 9,60,000. 9,60,000. Let me take my calculator. Not for this time I'm doing calculation and all. I was keeping calculator because from the next steps and all I need. Social welfare surcharge. Obviously it is how much? A 10 percentage on what? BCD. So it is how much? 96,000. There is no ADC, there is no social welfare, anti-dumping duty and safeguard duty. Then we got only two. This 2, 3. There is no 4 and 5. So we'll do subtotal here only. If this is the subtotal, how much, sir? 80 lakhs plus 9,60,000 plus 96,000. If you do, it is 90,56,000. Then we should levy what? IGST. IGST at what rate? IGST assume at a rate of 18 percentage. 18 percentage. So how much it is? 18 percentage. 16,30,000 is the IGST. So IGST on 18 percentage on what? You should levy IGST 18 percentage on subtotal. On subtotal. Then there is compensation cess. You should levy compensation cess, assume it as a rate of 10 percentage. On what? Again, this 10 percentage also on subtotal. This 10 percentage also has to be levied on subtotal. So 90,56,000 into 10 percentage, it is 9,05,600. Okay. Do we need to do this total? It is optional. You do or not, it's okay. But we need to find out total customs duty payable. So total customs duty payable, now you cannot tell only BCD. You should add all those things. Add all those things. Now what are those? This is 1. This is 2 here. This is 3. And this is 4. It is the total of 1, 2, 3, 4. How much it is? 9,60,000. 9,60,000 plus 96,000 plus 16,30,000 plus 9,05,600. Nine lakh 60,000, 96,000 plus 35,91,000 is the total customs duty payable. And the compensation cess and the IGST ITC that can be availed is 16 lakh plus 30,000 plus 9 lakh 5,000. It is 25 lakh 35,000 is the ITC that can be availed. Clear? This is the part, sir. This is the usual format. This only is needed actually. But I'll explain little bit for you. Okay. Basic customs duty. BCD, sir, here if you go into the previous page, there are duties. The duties can be classified into two types. What are those? Revenue duties and protective duties. Revenue duties and protective duties. The intention behind levying revenue duty is to generate revenue only. Whereas the intention behind levying protective duty is not to generate revenue. Yes, incidentally revenue will also come. But the intention is not to generate. Intention is not to generate revenue. Then what? Intention is to protect indigenous industry. The intention is to protect indigenous, I mean domestic industries within the India. What are the industries are there now? They are called as indigenous industry. So the intention is to protect them. Okay, when there are goods coming from other countries, because of them, if it is creating problem to the local manufacturers, then to protect them. Okay, Siri. Okay, Siri. Okay, when there is something problem to the domestic people, to the domestic manufacturers, then to protect them, there'll be some kind of protective duties will be levied. So the duties are of two types: revenue duties, protective duties. Okay, so to have clarity again, out of the format which we have, out of the points which we have discussed here, This is the revenue duty, basic custom duty. Social welfare surcharge is a revenue duty. AADC is a revenue duty, whereas safeguard duty, countervailing duty, anti-dumping duty, all these are protective duties. IGST is a revenue duty, compensation cess is a revenue duty, but the safeguard, countervailing, anti-dumping duty are protective duties only. Okay, now see, BCD, goods imported into India are chargeable to basic customs duty. Fine, we know. These rates of BCD are mentioned where first schedule of Tariff Act. Tariff Act has two schedules. First schedule is of import duties, second schedule is of export duties. So first schedule consists of BCD. BCD is usually levied at a standard rate. But if the goods are coming from preferential area na friendly country. Okay, friendly na, not friendly for you and me. For government it should be friendly, and government should have notified it as a friendly country. Then that is the preferential area. When the goods are originating from preferential area, then the rate applicable is preferential rate, which is a lesser rate than that of standard rate, concessional rate. You understand? So, sir, what I should do to get this preferential rate? First, your goods should be coming from preferential area. Okay, goods should be coming from preferential area. And not just they are coming from preferential area, it's not fine. They should be manufactured within the preferential area. Let's say Russia is our preferential country. It's not just goods coming from Russia. The goods should be manufactured even in Russia. Next, for getting preferential claim, to have that benefit of, to avail that benefit of preferential claim, that is your duty, your responsibility. So you should make a claim. You should make a claim that for me preferential rate applicable, please assess me at preferential rate. That claim has to be made by the importer. Specific claim for preferential rate must be made by the importer. And fourth one, you should have proper documents, proofs that the goods are really originating from the preferential area. If these four conditions are satisfied, then you have the benefit of availing preferential rate. So goods imported into India are generally chargeable to BCD. This BCD is a standard rate which is given in first schedule of Customs Tariff Act. Sir, this rate is not same for all the goods. For every good there may be a different kind of duty rate that we should take. Okay, now these tables are very important, sir. What is this table? Understand first. Import goods we are directly taking for home consumption. We are taking goods directly for what? Home consumption. So when we are taking home consumption, what BCD rate we should take? What BCD rate we should take now? The BCD rate at the time of submission of bill of entry will be submitted by whom? Importer. Or rate of duty at the time of entry inward. Entry inward will be filed by person in charge. Sir, I said the process and all. Again, recall, visualize and all I tell. Okay, entry inward will be filed by person in charge. Entry inward date related tax rate or bill of entry related tax rate, whichever is latter. Whichever is what? Later. Whichever is later. For you, I'm writing here once again. Very important. Where it is what? Home consumption. What we are referring here? BCD rate. If it is home consumption, what is the BCD rate? What is the BCD rate? Bill of entry or entry inward. Out of these two dates, whichever is later, the tax rate applicable on that date has to be taken. Whichever is later. Then exchange rate. Exchange rate. So what is exchange rate? Sir, accessible value. If the example you remember which I discussed 5 minutes back, here $1 lakh is given and the exchange rate is 80. Why we should take 80 and who will tell that exchange rate and all? We should take exchange rate given by CBAC. We should take given by CBAC, not by anyone. CBAC. That also on which day? Which day? As on the date of bill of entry. As on the date of bill of entry. Sir, if you forget this, die. Okay, in exam. Okay, I have said, sir, in my students in class now, I have told 10 times. But okay, out of frustration, this I am telling. But these people always forget this thing only. And how many times I tell? Again, while going to exam, for exchange rate, they will do whichever is latter. Exchange rate clearly I'm saying taken by CBIC as on the date of bill of entry. For BCD rate, you should take what? Whichever is latter. Whichever is latter among what? Entry inwards or bill of entry, whichever is latter. BCD rate. for exchange rate as on the date of bill of entry. Clear? Next. Sir, this is for home consumption. For warehousing, what we should do? Sir, if you remember the concept of warehousing, this is the warehouse. We'll file two bill of entries. One bill of entry at the time of warehousing. There will be another bill of entry at the time of removal from warehouse. This bill of entry will be in form 2 yellow color. This bill of entry will be in form 3 green color. This is bill of entry for warehouse to home consumption. This is for warehousing. Yes. So now for warehoused goods, if we need to pay duty, what rates we should take? Bill of entry for warehousing. This we call it as inbound bill of entry as well. Inbound bill of entry, because the goods are going inside the warehouse, inbound. So while doing this warehousing, you need to execute a bond. Like future, I'll pay the duties and all on time. So like that, you'll be executing a bond, inbound bill of entry. Here it is exit, coming out, exit. So here this is called as what? Ex bond bill of entry. Ex bond bill of entry. Inbound bill of entry, ex bond bill of entry. So now come back here. BCD rate for warehousing to home consumption. You are removing the goods from warehouse to home consumption. So then what BCD rate you should take? BCD rate as on the date of X bond bill of entry. X bond na while you are removing. Whereas exchange rate na given by CBEC as on the date of inbound bill of entry, as on the date of inbound bill of entry. So this inbound bill of entry date related exchange rate you need, exchange rate. Whereas this ex-bond bill of entry related tax rate you need, tax rate. Here tax rate, here it is what? Exchange rate. Here tax rate, here it is what? Exchange rate. Okay, this is very, very important. In any other case, rate of duty is the rate prevailing on the date of payment of duty. Exchange rate as prevailing on the date of payment of duty. Okay. Let me. Okay. Before going further, we'll discuss additional duty to compensate excess duty. Sir, this is previously, before GST, there used to be excess duty. So, whenever there is an import of goods, in addition to BCD, there is equivalent of excess duty. This is called as CVD, equivalent of excess duty. But you should understand now, excess duty is no more. Excess duty is subsumed into GST. Since there is no excess duty, we don't have much relevance on this. But you should have this point of clarity. There are certain goods which are currently out of the ambit of GST. What are those? Alcoholic liquor for human consumption, petroleum products. On tobacco, there is both excise as well as GST. So on this, okay, the scope of this is very limited. So on alcohol, petroleum products, on tobacco products alone, there is CVD. Okay, on others, there is no CVD. So problematic perspective, not much relevant. Special CVD. This is equivalent of VAT. Previously, there used to be VAT. So on goods imported, there will be BCD, there will be CVD, there will be special CVD, which is equivalent of VAT. Okay, but now it is not there. Okay, this is previously it used to be up to 4%, not more than 4%, and it is there currently only on petroleum products. Only on petroleum products. Now social welfare surcharge. How much is the social welfare surcharge to be levied? The social welfare surcharge to be levied is maximum of how much? 10%. Maximum of 10%. And 3% on goods like gold, silver, platinum. High speed diesel oil, it is only 3%. One more important point, sir. Social welfare surcharge is 10% and it is leviable only on import. If on export, even though there is BCD, there is no social welfare surcharge. No social welfare surcharge on export. No social welfare surcharge on export. Write it. No social welfare surcharge on exports, only on imports. ADC, Agriculture Infrastructure Development Cess. This is an additional cess levied in order to generate money, in order to collect money from people by way of tax, which would be specifically used in agriculture related sectors by the government for projects, construction, for water canals and all. For that purpose only they'll use. ADC is levied on import of specified goods at notified rate, which will be given in the question if at all asked. Some of the notified goods are apple, silver, alcohol, petrol, and this is levied on assessable value only. Next, IGST. IGST is a component of GST law. Why IGST? Why not CGST and SGST? If you go and refer section 7 of IGST Act, which defines interstate supply, which defines what is called interstate, so if you go and read there, which defines interstate, there it is clearly said like import is always an interstate. Since it is an interstate, you should levy IGST. So GST is a component under GST law which is levied on goods. IGST will be levied on imports. The rate of IGST shall not exceed 40%. It is the total of what IGST shall be levied on subtotal na assessable value, add BCD, add social welfare surcharge, add ADC, add anti-dumping duty, countervailing duty, so safeguard duty, whatever are there, add on the total only you should levy IGST. Next, compensation cess. Already discussed in the introduction chapter, but if you are listening customs first, compensation cess will be charged on luxury products like high-end cars, demerit commodities, which are not necessary for day-to-day use, like pan masala, tobacco, cool drinks, okay, for a period of 5 years, but now it is extended for another 4 years, total 9 years. Okay, so compensation cess is levied by government to generate revenue, and such revenue will be used by central government to compensate the state governments which are losing revenue, which have loss of revenue due to introduction of GST. So GST compensation cess wherever applicable would be levied on cargo that would arrive on or after 1st July. Okay, the same value on which IGST is levied, on the same value compensation cess also has to be levied. So till now it is clear now. So now we can go on quickly solve some problems and we'll come back. Sir, it's my guarantee, sir. Follow me. You could solve any problem from customs. I'll not exaggerate things generally. So whatever I'll tell frankly. If I say, like, if I cannot cover something, I'll tell I'm not covering this thing. Okay? I don't know to bombard na new word which I learned. No, I learned long back, but I didn't use it quietly, like telling something great about me, like I did that much great, I'm this much great and all. If I tell na, that is okay. In Telugu we call it as like dabba. Okay, something, keep on telling like that. Okay, that's not and all. That and all I don't know. So come back here. An importer imported some goods for subsequent sale in India at $10,000 on assessable value. Relevant exchange rate and rate of duty are as follows. Bill of entry, date given, entry inwards given, IGST is 18%. They are asking to calculate assessable value. But see here, exchange rate. First we need is exchange rate. Okay. What exchange rate we should take? Exchange rate as on bill of entry, entry inward, bill of entry given by CBSE. On bill of entry, what is the exchange rate? 58. Okay. Then what is the BCD rate we should take? Bill of entry or entry inward, whichever is later. Bill of entry is on 25th Feb. Entry inward is on 5th March. Later na entry inward. So we should take 12%. So let me quickly solve here. We should take assessable value. How much are assessable value? $10,000. $10,000 into 58. If you do, you'll get how much? 5 lakh. 58,000. No. 5 lakh. 5,80,000 only. 5,80,000. On this we should have a BCD. BCD what rates are? BCD if you check here 12%. BCD 12% on it. Levy here. Then social welfare surcharge. You'll forget macha. See here anywhere is there social welfare surcharge related clue? No clue in the question, so you'll forget. Remember. Social welfare surcharge on imports even not given in the question we should take. So social welfare surcharge levy at a rate of how much? 10%. So this fellow levied social welfare surcharge 6,960. Then we should do subtotal. Okay, what is the BCD, sir? 69,600. BCD 69,600. Then 6,960 is the social welfare surcharge, 10%. Then you should do what? You'll get what? Subtotal. What is this subtotal? Subtotal na, it is nothing but the total of all these two. What is the total of these two? This fellow didn't did. You do total. On this total only we should levy what? IGST. IGST at what rate? Given in the question. 18%. 18%. This 18%. If you levy, you'll get this. And what is the total customs duty payable? 1 BCD, 2 social welfare surcharge, and 3 IGST. If you add these 4, you'll get the total customs duty payable. Clear? Okay. Come to question number 2. There's a mistake in this question, sir. But still, I'm here now. Don't worry. An importer imported some goods, entry inwards on 7th February, and goods were cleared for warehousing on 8th February. The bill of entry was present on 1st February. Assessable value was $10,000. No additional duty is payable. They were warehoused. So for warehousing, there are 2 bill of entries: inbound bill of entry, ex-bound bill of entry. You understand now? So the question is related to that. Simple only, related to that. So for warehoused goods, which dates exchange rate we should take? Inbound bill of entry. Customs duty rate, ex-bound bill of entry. So inbound bill of entry. So the date of submission of bill of entry for warehousing, this is inbound. The date of clearance, this is ex-bond. So we should take inbound ka exchange rate. We should take ex-bond ka custom duty rate. So 55 and 15. So 10,000 into 55 will get 5,50,000. On that 15%, 82,500. Social welfare surcharge will get 6,40,750. Then IGST given in the question, yes, at a rate of 12%, you will get 76,890. So the total customs duty payable is 1,67,640. Sir, if you want to solve now, take screenshot and solve the question. Only you solve, you will get. If you listen, you will not actually get. Solve the questions. Or if you want material, so this material and all, we are not providing soft copy, sir. I'm very, very extremely sorry for you. These are available for sale as hard copy. Okay, then for export. Sir, export na what rate will take? So export, sir, we should take the date as on the entry outwards, sir. Entry outwards ka tax rate we should take. Okay, clear? Entry outwards. So now coming back to the concept only, sir. 1, 2, 3. Hardly in types of duties we are having 3 concepts, sir. First one, safeguard duty. Why safeguard duty has to be levied? Safeguard duty is levied and there are increased imports. So let's say this particular mouse is there, na? There are increased imports of these mouses into India, or laptops or mobiles. Increased mobiles into increased number of so many mobile imports are there into India. Okay, sir. What if we don't have many manufacturers here? That's why there are many imports, sir. Not just importing is the problem. There are many imports and they are causing or threatening to cause serious damage or injury to the domestic industry. So by importing so many goods, domestic industry is in a situation that it will collapse completely. So somehow Indian government has to make sure that Indian industry will also survive. So to make them survive, some measures has to be taken. One of them, such measure is safeguard duty. Safeguarding our indigenous industries. So see, if goods are cleared in DT, okay, safeguard duty is product specific. Sir, it's not on a country it is levied. It's levied on a product. So mobile may be coming from USA, Russia, China, Vietnam. So many countries, from so many countries you might have import of such product. But such product is coming at a increased levels, and because of that increased levels, our indigenous industry is damaged or threatening to cause serious damage or injury. Okay, already it caused serious damage or injury, or it is in a position that to cause serious damage or injury, then we should levy safeguard duty. If on inquiry, if it is satisfied that those goods are imported into India in increased quantities and such an increased importation is causing or threatening to cause serious damage or injury, then safeguard duty shall be levied, and it is product specific. The duty imposed under this section shall be enforced for a period of 4 years. Once you bring safeguard duty, it will be there for a period of 4 years, and it can be extended with the total period of levy not exceeding 10 years. You can extend it for a total period of how many? 10 years. But initially you can bring it for 10 years. Next, when they are doing, sir, the local industries went to government and given a representation like, sir, these products are coming at a high quantity, sir, these are causing injury to us, so please take some action. Now government will have some committees and all, na, they are checking that. If their study takes time, na, they'll do some preliminary, not the final examination, preliminary examination, and they believe like there is damage or may chances of causing injury to the domestic industry, then they levy provisional safeguard duty. The provisional safeguard duty will remain in force for a 200 days provisionally. This is in term, not the final one, in term. Okay, safeguard duties shall not be imposed in the following cases. First one, when the articles are imported by a 100% EOU or SEZ, when the goods are imported by a EOU or SEZ, 100% export oriented undertaking or SEZ, then there is no safeguard duty. Understand? When the goods are imported by a 100% export oriented undertaking or SEZ, then there is no safeguard duty. Next, articles originating from developing country. When the articles are originating from developing country, sir, listen. These are developing countries. This is developing country A, B, C, D, E. All these are developing countries. From this developing country A, there is some 30 crores. B, another 20 crores. C, another 15 crores. D, another 20 crores. 50, 65, 85, and here another 15 crores. You understood? And from others now they are developed countries only. 50, 65, 85, 100. There is another 9,900 crores. Total how much it is? 10,000 crores. Out of 10,000 crores, 30 crores. Now how much, sir? Sir, not 9,900. I'll make it as just 900 crores. So it came to total how much? 1,000 crores. Okay. 30 divided by 1,000. It is how much, sir? 3%. 3%. 2%. 1.5%. 2%. 1.5%. What the first point says, like, when goods are being imported from developing countries, yes, all these are developing countries, and the share of imports from the developing countries compared to the total imports is less than 3%. Sir, how we calculated 3%? This is nothing but 30 by 1,000. 1,000 is the total, 30 is from that country. If when the imports from such developing country are less than 3%, then there is less than or equal to 3%, then there is no safeguard duty. So here no safeguard duty, here no safeguard duty, here no safeguard duty, here no safeguard duty. This first point. But the second point comes and says, like, even though individually they are less than 3%, when they are totaled and checked, when the collective total is more than 9%, then safeguard duty is leviable. What is the total here, sir? Total of this 5, 6.5, 8.5, 10%, where the individually less than or equal to 3, but more than 10%, then safeguard duty has to be levied. So safeguard duty is applicable on all these countries, even though individually less than 3%, collectively more than 9%, safeguard duty is applicable. Let me give another example. Okay, this. Okay, So I'm simple change, sir. I'm making this as 40 crore and I'm making this as 5 crores. Nothing changed. Just the percentages will change here and here. 40 crores now here it is 4%. 5 crores now it is 0.5%. Okay. Now tell me, it is from developing country A, it is individually more than 3% now. So here safeguard duty is applicable. Okay. But here less than 3, less than 3, less than 3, safeguard duty is not applicable. But we should check even aggregately also, na. So if you check aggregately, it is 6, 7.5, 9.5, again 10% only. But you should not include this one. You should not include this one while considering the total, where the individually a country's share is more than 3%, on that safeguard duty anyhow is applicable. So that you should exclude while checking the aggregate. While checking the aggregate, exclude this. So only for this 4 you should total. What is the total of this 4? 3.5, 5.5, 6% only, which is less than 9%. So safeguard duty is not applicable on this. So you understand the difference now. Here safeguard duty is applicable on all. But whereas here safeguard duty is applicable only on a country. Here on all of them safeguard duty is applicable. I hope you are understanding my point, sir. This is what safeguard duty. Safeguard duty. Quickly, let us go and solve some problems on safeguard duty, sir. See. Yeah, question number 9. Determine the safeguard duty payable by X Limited under Section 8B of Tariff Act. X Limited imported sodium nitrate from a developing country on 26th February to 25th, 50 crores. The total imports of nitrate is 2,500. Okay. Okay, generally, sir. First, they didn't mention it as developing country. Since they don't mention it as developing country, we'll assume safeguard duty is applicable. So what we should do? 50 crores na, on this we should multiply 30% because question itself it is given. What if your answer is, whether your answer is different, if it is from a developing country and the amount is 50 crores, no 80 crores, not 50. 80 crores na, then 80 by 2,500 you will do. 80 by 2,500 na, how much, sir, it is? What is the percentage? 3.2%. 80 by 2,500 na, it is 3.2%, which is more than 3%. So safeguard duty is applicable even though from a developing country. If the value is 80 crores, safeguard duty applicable. If the value is 50 crores only, then safeguard duty is not applicable. So see this one. Determine the safeguard duty payable by X Limited, Y Limited, Z Limited, A Limited under Section 8. Sodium nitrate from developing and developed countries. So the last developed countries is 2,256, whereas from developing countries we are having 4. What we should do? Percentage calculation. If you do percentage calculation and all, 2.8, 2.88, 2.08, 2%. Individually, none of these countries' share is more than 3%. But you should check what aggregate. Aggregately, if you check now, it is more than 9.76%. So safeguard duty is applicable on all those countries. So which is nothing but 70 into 30%, 72 into 30%, 52, 50 into 30%. So this is the safeguard duty to be paid. Next one. Determine the safeguard duty payable by X Limited, Y Limited, A Limited and all those countries where, okay, you should check. Now, what are the percentages calculations? The same questions are nothing changed, but few little bit numbers has been changed. On first country, it is how much, sir? 2.8%. Whereas second country, it is 3.28 because it is 82 crores. 2.08, 2%. So for Y Limited alone, if you check, it is 3.28%. So safeguard duty is applicable. Whereas for the other three, if you check, it is total 6.88% only, which is less than 9%. That means only for Y Limited safeguard duty is applicable. For others, safeguard duty is not applicable. Others, it is not applicable. Clear? Clear? Okay, let me go into the next concept. Sir, very easy, sir. If you have some doubt now, listen to it once again, go back, listen to it once again, take the book, take the pen and paper, solve it for once. It is very easy, sir. Don't lose this 11 marks from customs unnecessarily, sir. Okay, and the introduction related 16 marks and this customs related 11 marks, please don't miss. And I'll tell even value of supply and ITC, there some 9 to 10 marks. So sir, I'm covering only few topics in this marathon. What are those? For you have this. intro, customs, value of supply plus ITC. Intro and customs. Sorry, intro 16 marks, customs 11 marks, value of supply and ATC another 9 marks, minimum 20, 36. And MCQs. If you go and watch MCQs, now there another 2 MCQs will also. So this hardly, sir. Customs we are covering this in 3 hours. Intro some 2 hours rough, 3, 5, 6, 7 hours and plus that one. One day is enough, sir, for IDT. Even if you don't study also, no, one day is enough. Okay, countervailing duty. Countervailing duty is levied if the articles are imported into India by getting subsidies. They are imported into India, sir. But how that fellow is importing into India? Their country, let's say China is giving so much subsidies, sir. Subsidies, na raw material usually it costs 100 kg, 100 rupees per kg for them. Rupee I'm using for our convenience. Okay, 100 rupees per kg. But since they are exporters, China is providing them raw material at only 30 rupees per kg. Since they are getting at 30 rupees per kg, they can produce so many goods and they are exporting at lower prices to India. But our poor manufacturers will not get for 30 per kg. Na? They are paying 100, 120 rupees per kg. So for them the cost is so high. But whereas this China person is sending for low cost. Why he is sending for low cost? Now he is getting subsidy in his country. So he could sell at a lower price. So that benefit not available to the indigenous manufacturer. So we should control this. That's why duty levied if the articles are imported into India by getting subsidies from other country. Duty levied if articles are imported into India by getting subsidies from other countries. The amount of countervailing duty shall not exceed the amount of subsidy paid. Okay, so whatever the countervailing duty will levy should be equivalent to that of the subsidies that are being given by the foreign government or foreign countries. Okay, CVD cannot be levied if they are related to export performance and all. Okay, next. It shall be, once the countervailing duty is levied, it will be enforced for a 5 years and extended for a further period of 5 years. If it is taking time to find out the countervailing duty and all, in the meanwhile, they can go for a provisional safeguard duty also. Okay, and final determination, if there is any excess payment, they'll refund. If there is any deficit, you should pay along with interest. Then this countervailing duty can be imposed even with a retrospective effect for a period not prior than 90 days. This can be levied even with what? Retrospective effect, but not for a period beyond 90 days, within 90 days only. CVD is not applicable when they are from EOU SEZs. Okay, unless if it is specifically said by a notification, like even for SEZ and EOU imports also it is applicable, unless if it is specifically said. In general, CVD is not applicable on them. No problems also, sir. Hardly a chance of asking MCQ. Anti-dumping duty, the last one, sir, here. Anti-dumping duty. It is imposed on imports of a particular country. Imports of a particular country. Country-wise, sir. Safeguard duty, product-specific. Anti-dumping duty, country-wise. Country-wise. From a country where there are so many products. So then, sir, it is also a product. Let's say mobiles only. Safeguard duty, na mobile, if it is coming from China, Japan, whatever the country, you levy safeguard duty. But anti-dumping duty, if on mobiles also, if they are coming from China, only from that country, anti-dumping duty. If they believe like there are such grounds. If it is coming from USA or some other country, then there is no need of levying anti-dumping duty. Anti-dumping duty is a country specific. If it is levied for a product, it doesn't mean it is applicable on all the products coming from different countries. Only from, if it is coming from a particular country, it is applicable. When, sir? Understand this. Sir, a China company which manufactures mobiles, it has demand of 10 lakhs units in China. It produces the same. It has demand of how much? 10 lakh units. One second. It has a demand of 10 lakh units in China. And the price they are selling is for 20,000. Their currency only, assume. Okay. And the cost for them to produce is 15,000. Now, their costing related engineer or the cost manager said like, when the production doubles from 10 lakhs to 20 lakhs, cost here 15,000 na, if they produce 20 lakhs it will come down to 10,000. So when they double the production, their cost will come down drastically from 15,000 to 10,000. So what they thought means, what they are doing means, in China they cannot increase demand. So in China, this company, what they are doing means, they're selling in China. How much they're, so previously if you see now how much, sir, 5,000 into 10 lakh units. This is their profit. You understand? That is their profit previously. Now in China they'll sell 10 lakh units only. But since they increased production, the cost, I mean their margin is how much, sir, now? Half. Okay, selling price minus cost price. So which is nothing but how much? 10,000. So now their profit almost doubled because 10 lakh into 10,000, 5,000 margin, it got doubled to 10,000. The question is, so what they'll do other 10 lakhs, sir? Just because they increased production, they cannot sell all those now in China. What they'll do? They'll send them to India. Sir, India also who will buy, sir? Yes, they do know who will buy. That's why they'll give it for low prices. Once they given for low prices, now in India also will buy now. So India, they'll sell this 10 lakh units, each for a break even. At 10,000 only they'll sell. Sir, you understand now? For 10,000 only they'll give. In China they are selling for 20,000, but in India they'll give for only 10,000. So understand, the price which they sell in China is far more than that of the price which they are selling in India. So the price which they are selling outside India, na, okay, this is called as normal value, market value in the exporting country. How much, sir? This is 20,000. At what price they are selling in China? 20,000. That is called as normal value. Whereas the export price, the price at which they are exported, at what price they are sending here, sir? 10,000. So 20,000 they are selling in their country, but India they are sending for 10,000. This 20 minus 10, this 10,000 difference is there, na? This is called as dumping margin. So from they are dumping into India for a price which is lower than that of in China, in their country. That is called as dumping margin. So that dumping margin you should calculate. The next one, injury margin. Injury margin, na, our domestic people will sell this product for 18,000. I mean our Indian manufacturers are selling this kind of products for 18,000. So at least if this good is sold in India for 18,000, it's fine. But they are not selling for 18,000 also. They are selling for 10,000 only. So the injury, Indian industry affecting because of what? Because it is selling for less than 18,000. Not just for selling for 10,000. It is injuring because it was sold for a price less than 18,000. If it is sold for 18,000, then no problem. Competition, fair competition. Everybody is having 18,000, but they are selling for less than 18,000. So find out the price at which they sent the import price. Import price na, that 10,000 plus customs duties and all you levy, that is called as import price. BCD and safeguard duty, if you levy, sorry, BCD, SWC levy, that is called as import price. And that and all, this difference is called as injury margin. That injury margin will be levied as what? Anti-dumping duty. So this is nothing but anti-dumping duty is margin of dumping or injury margin, whichever is lower. Even anti-dumping duty also can be, once it is levied, it will be in force for a period of 5 years. Even provisionally, anti-dumping duty can also be levied. Let us go and solve one question, sir. Only one or two questions. One question is enough, sir. The same format, sir. The other question also. That's why. Same model question, sir. Whenever we have anti-dumping duty, they'll ask same model of question. So don't confuse. Simply, aram se, you read the question, you can do it peacefully. A company is imported into, a commodity is imported into India from a country covered by notification issued by central government under Section 9A of Tariff Act. CAF value $25,000. Whereas the quantity import is 500 kgs, exchange rate 60, BCD 12%, SWS 1%. But anti-dumping duty will be equal to the difference between cost at 70 per kg and the landed value as imported. So we should find out something landed value and we should calculate. So see how I'll calculate this question. First take the assessable value. What is assessable value here in this question? CAF itself is the assessable value, $25,000. What is the exchange rate? 60. So assessable value in rupees equals to $25,000 into 60. Multiply this, you'll get how much? Hey, don't wait for me to answer. You solve. 15 lakhs. On this first levy BCD. What rates are BCD? That will only given directly 12% and SWS 10%. This 16,98,000 only landed value. Once they are landed into India, value is called landed value 16,98,000. Clear? Nothing new I discussed, sir. Now anti-dumping duty. I am not doing anything great, sir. Listen to the question. Anti-dumping duty will be the difference between the cost of commodity calculated at 70 per kg. So let me calculate here. Anti-dumping duty I took here. Cost. How he is asking me to calculate? Take 70 per kg. Okay, I'll take 70 per kg. What is the kg value? I'll take 70 per kg. What is the kg value here? The kg value here is, sorry, how many kgs? 500 kgs. Per kg, how much you should take? $70. $1 equals to how much? 60 rupees. So, cost equals to 500 kgs. 500 kgs into 60. Sorry, 500 kgs into 70 per kg into 70. Convert into rupees. Multiply it with 60. You'll get cost. Do. Sir, I'm stressing this many times. Why? Only if you solve, you will get. If I solve, I will get. What the purpose if I again learn this? Already know. Already clear. Me doing on my own is no value addition for you. You should solve. One time watching this marathon and along with me if you're solving this now, fine. You remember. Cost. 500 kgs. This one. $500 kgs into 70 per kg into 60 rupees. Okay, how much sir this is? 500 into 70 into 60, 21 lakhs minus, he is asking to subtract landed value how much? 16,98,000. How much it is? 4,02,000. This is the anti-dumping duty. You see, 4,02,000 is the anti-dumping duty. Okay, so no levy anti-dumping duty. After levying anti-dumping duty, you will get how much? 21 lakhs. This we call it as what? Subtotal. After adding anti-dumping duty, whatever the total will get, that is called as subtotal. On this, we should levy IGST. What is the percentage of IGST rate given in the question? Is it given or not? Sorry, it got missed, sir. Here you could see 12%. IGST 12%. 21 into 12%. How much it is? 2,52,000. Okay. Customs duty payable now. What you should do? This 1,80,000. This 80,000. This 4,02,000 and this 2,52,000. This 1, 2, 3, 4 total is there now. That total is the total customs duty payable. You got my point, right? Okay. The next sum is also same kind, sir. No difference and all. No value addition from that. Okay. So before closing this chapter, we have even export procedure also. Quickly, let me give you the export procedure also. Export of goods. When you are exporting goods, sir, two things. First, if you are an exporter, you want to send your goods outside India, you should file a shipping bill or bill of export. Shipping bill or bill of export. Shipping bill is when the goods are being exported through a conveyance, being vessel or aircraft, you will file shipping bill. Bill of export when the goods are land route na bill of export, that you should present. Exporter should file bill of export or shipping bill. Okay, fine. And then the customs office will verify, and when they are satisfied that there are no prohibited goods, if any duty is there that is paid, then they'll give you let export order. So file shipping bill, bill of export, get let export order. One thing, keep it aside. Then you should be loading these goods into a vessel or truck na. This vessel guy should get an entry outward. This vessel guy or aircraft should get an entry outward from there. Again, customs office. A vessel intending to start loading must first granted entry outwards. So entry outwards must be there from the vessel perspective, and from the export perspective, what? This let export order must be there. When these two are there, then the exports goods shall be loaded into the conveyance with the permission of person in charge. He'll allow them only when there is a let export order. Okay. The person in charge, once the goods are loaded, then he'll file EGM, okay, which is called export manifest. Import IGM, here EGM, export general manifest, filed. Once it is filed, final, these are the goods, these are the passengers, these are the crew members, everything, he will be filing the list to the customs office. Customs office will once again verify and give a written order. Okay, everything pakka, clear, you can go. Then ship can leave. This is the process of export. Simple, sir. Exporter files bill of export or shipping bill. Customs office verify and give let export order. Even the conveyance person will also get an entry outwards. These two order. Then the goods can be loaded into the conveyance. Once the goods loading and all passengers boarded, everything is done, then the person in charge again file a EGM, export general manifest. Once the export general manifest is filed, the customs office will verify and give a written order. Then the vessel can or the conveyance can leave India. This is the process of export. Okay. With this, we cleared even this particular topic as well. Only valuation. Quickly. Hey, welcome to valuation chapter from customs. Again, in this chapter, problematic only. Quickly. We'll do this chapter in one go. Okay. But before going into this chapter, I think you not yet like this video. Like video. First to go on like. Then put a comment na. Put some comment whether you're understanding or not. You're able to follow something. Put a comment why you're waiting. Put a comment first. Then from BCCA, for all the 8 subjects at inter level, at final level, we have marathons. Share the marathon with your friends. Let them be aware of these things na. Why you alone pass? Why so selfish? Share with your friends, seniors, juniors. Okay, and this video especially a 20k subscribers special video, so don't forget to share, like, subscribe to BCCA. Okay, now too much of promotion, huh? A little bit is needed, little bit is needed now in between. So valuation of imported and exported goods, how the valuation is going on and all. Okay, sir, here valuation of imported and exported goods, the valuation is of 2 types: transaction value, tariff value. Transaction value na, we call it as ad valorem duty. I mean, let's say I purchase for some 1 crore, then 1 crore will take it as value, customs value, on that will levy customs duty. That is called as ad valorem duty. Whereas tariff value na, like in the beginning of customs also I said, like on crude oil, cigarettes, the tax will be levied on based on the quantity. Crude oil. On cigarettes, the tax will be levied based on the length of it. So quantity, volume, measurements, if they are the base, then they are called as tariff value, specific duties. When on value, if you are levying it as a percentage, it is ad valorem duty. 14 subsection 2 provides that board may fix tariff values. It fixes a tariff value that would be considered here. Any class of imported goods or exported goods having regarding to the trend. Whereas such tariff value are fixed, the duty shall be levied along with them. Next, bill of lading. So what is this bill of lading? This bill of lading is a document which is given by the transporter. The transporter na, the conveyance guy. either it is aircraft, vessel, okay, they will be giving this document. Okay, so once you want to take the goods, let's say you have imported the goods, if your goods has to be handed over to you, then you should provide this bill of lading. So bill of lading is a negotiable document given by the carriers of the cargo. It consists of details of port of shipment, where the goods are being sent. Let's say in Australia it was started in Sydney airport. If they are coming to Mumbai, na, port of shipment Mumbai, number of packages, any numbers, references, then the name of the vessel in which they were sent, and the name of the consignee to whom which they are sent, whether the freight is prepaid or postpaid. This will be there in the bill of lading. Next, board charges or light rate charges means board charges or light rate charges. This is India now. Sir, a big ship is coming, sir. This is a big ship. But the problem is sometimes the ship cannot come to port. What? Ship cannot come to port. Why, sir? What's the problem? Because the sea depth may not be constant. Because of the sea depth may be constantly changing. So because of that reason, the ship cannot come to port. Then how the goods will be transported? These goods will be transported using small boats. Okay, the small boats will be used. The freight paid the small boats. Freight paid to the small boats is called as light rate charges. Light rate or boat charges. You understand now? Sometimes the big ship cannot come into the port because of the depth of the sea or some other technical reasons. Then the small ships will be sent. By using the small ships, small boats, the goods will be transported from the main ship to the port. Okay. Then place of importation, the customs station where the goods are brought for being cleared for home consumption or removed for deposit in warehouse is called as place of importation. Next, related person. Who are called related persons? If they are officers or directors of one another business. Sir, I'm a director of B Limited. Then me and B Limited are related persons. And B is director of my company. So we both and our companies are also related persons. They are legally recognized partners. That means they are partners in a partnership firm which is registered. Then they are related persons. If they are employer and employee relation, related persons. If one of the person holds directly or indirectly more than or equal to 5%. Let's say I have 6% shareholding in Reliance. I don't have. If I have 6% in Reliance, obviously why I'll take classes and all. Okay. If I have 6% in Reliance, then me and Reliance are related persons. Reliance Industries. Next, one of them directly or indirectly controls the other. Sir, without 5% also can we control? Sometimes, very rare cases it happens. If there is a situation of me controlling an entity, even though without having 5% shareholding, then both of them are also called as related persons. When both of them are directly or indirectly controlled by a third person, joint venturers. That means A, B together. Let's say Vodafone and Idea. Vodafone and Idea are two companies, sir, but they together started VA. Okay, that is called as what? A joint venture. So joint venture, Vodafone and VA are related persons, Idea and VA are also related persons. Together they indirectly are, okay, this one, controlled a third person. They are members of the same family. If they are members of the same family, then also they are related persons. So this definition is same even in GST. The only difference is in GST here instead of 5% it will be 20%, but here it is only 5%. Okay. Now we should understand one thing, sir, before going further. Sir, assume this is Australia. Okay, forget about the directions and also don't tell me like Australia this side and all. This is India. This is the factory in Australia. So now we want to find out assessable value, sir. In this chapter, our aim is to find out assessable value. Understand, assessable value equals to CAF value. So we need to find out that assessable value or CAF value. That is only our target. Okay, so how do we find out that assessable value now? Let's say the price given in the question is like the price which is agreed, like when the goods are going to be delivered at the factory gate of Australia. Let's say the seller agreed to give the goods or hand over the goods to you in his factory premises, at his factory gate. Let's say here is the factory now. So if the goods are going to be delivered here, then this is called as ex factory price. I mean the price when the goods are agreed to be delivered at the factory gate in Australia, that is called ex factory price. Here sir, this green color dot is there now. This is port. When the goods are brought till port gate, then that is called as FAS, free alongside. Free alongside. Free alongside na price at port gate. Price at port gate. Port gate na which country port gate? Exporting country, Australia port gate. Ex factory price na price at factory gate. Factory gate of whom? Importer or supplier? Supplier. Supplier na nothing but exporter. Price at factory gate of exporter is called as ex factory price. FAS na free alongside. Price at the port gate. Then here the goods, okay, the goods has to be come by ship na. Now this is the ship. Okay, once the goods are loaded into the ship, goods kept here, once the goods are loaded, then that is called as FOB, free on board. Free on board. Free on board is the price when the goods are loaded into ship. Price when goods loaded into ship. Price when good loaded into ship. FOB. Then here the ship will come here na India and will get here. This price is called as CAF value. Price at port of importation. Price at port of importation is called as CAF value. CAF now cost, insurance, freight. So I have told you 4 definitions are now. One is FOB. One is, sorry, first one sir. I have told you 4 definitions. The first one is like what? Ex factory price. Ex factory price. Ex factory price means what? Price at factory gate. Of whom? Price at factory gate in export country. Let's say for easy understanding, assume it as Australia and we import in India. Price at factory gate which is in Australia. Okay, ex factory price. How do we arrive ex factory price? Ex factory price is nothing but cost plus margin. His cost plus margin itself is the ex factory price. Then we should arrive FAS. FAS na about the price at the port gate. Price at what? Port gate. So price at the port gate. One second, sir. Now, FAS. FAS means nothing but what? Free alongside. So for ex factory price, what and all this is nothing but what? Price at port gate. Port gate. Port gate where? Export country. So to arrive FAS, what and all we should add? So for cost and margin, we should add here. To arrive FAS, we should add local freight. So local freight na the freight which we incurred in Australia. Example reference. Export country is Australia. Local freight, local taxes, local insurance. If you add these things, then you will get what? Free alongside. Then it is nothing but price at the port gate. Then you should get FOB. FOB na free on board. FOB means what? Price when onboarded into conveyance. Price when the goods are onboarded into conveyance. Conveyance, either aircraft or vessel, whatever it is. So for this, what we should add? We should add the loading and handling charges in the port. Loading and handling charges. And even we add, if any, export duty. Add export duties, if any. Export duty, if any. So FOB, from ex-factory price, you should add cost and margin. Ex-factory price is nothing but cost plus margin. In any sum, they'll give ex-factory price minimum. So, okay, the bare minimum they'll give is ex-factory price. Or else directly they can give FOB also. But some questions they may give even ex-factory. Ex-factory to FOB, how will arrive? You'll add the local taxes, local freight, local insurance, loading and handling charges and export duty. Then you'll arrive FOB. Sir, here ultimately the last point, which is accessible value, is like CAF value. CAF value, cost plus insurance plus freight. This is price at place of importation. I mean Indian port. Price at place of importation. This is the accessible value. I mean, we'll be levying customs duty on this value, accessible value. So our job is to find out this price at place of importation. But for this, if you add freight and insurance, obviously it is accessible value. But customs said, like, if there are any incidental expenses, if they were not included, add them. After adding incidental expenses only, you should calculate FOB. So this FOB, we should cross check whether the incidental expenses are included or not. If not, then we'll be calculating one more point called as FOB customs. FOB customs. So FOB customs for here we should add incidental expenses. I'll list out all of them also. Incidental expenses, what are those? I'll add them one by one. I'll write. Okay, this is the FOB customs. Okay, this is nothing but FOB plus incidental. This only customs will accept. Okay, you cannot take this FOB. If this FOB is given also, you should calculate this FOB customs. That only should be, you should find out mandatorily. You'll add this. Okay, what are those to be added, sir? First one. Commission and brokerage. We should add what? Commission and brokerage. Except buying commission. If something mentioned in the question as buying commission, don't add buying commission. Don't add buying commission. Commission and brokerage. Next. Packing cost. Any packing cost is there, na? Add. Third one, designing charges or any technical designing charges, they should be incurred outside India. This designing charges should incurred outside India. Definitely this designing charges should incur outside India only. Designing charges, then only add. This development designing charges, if incurred outside India only, add. Incurred in India, don't add. Incurred in India, don't add. Okay, incurred outside India, we shall add. Commission, brokerage, packing, designing, you should add. Commission, sometimes they will give in rupees, sometimes in foreign currency. Rupees also add, foreign currency also add, but don't add buying commission. Packing cost, you should add. Designing charges, incurred outside India, add. Next, fourth one. Royalty or license fee. If any royalty or license fee is there, add. Royalty or license fee, you should add. Then fifth one, sir, you should add inspection charges. If any inspection has to be carried out as per contract, inspection. Then free of cost material given. Free of cost material given. Then the last seventh one, free of cost, sir. Actually, it's the supplier job to provide me a machine, but I have some components which can be used to manufacture that machine. So I provided those components which I am having with me at free of cost to the supplier. So whatever is the cost for those components, add it. Then the last one, if any resale proceeds. If I am going to share, sir, Meena importer, if I am going to share any of the sale proceeds with my exporter who is in abroad, that amount which I am going to share, add. Resale proceeds. This 7 points, sir. Commission and brokerage, packing, designing charges, royalty license fee, inspection charges, free of cost material given, and resale proceeds. If you add these 7 points, you'll get FOB customs. So we cannot take FOB directly unless these 7 points are not there in the question. Otherwise, you should calculate mandatorily FOB customs. Okay. Then you arrived FOB customs. To FOB customs, after adding this, you got FOB customs. Then add freight plus insurance. If you add freight plus insurance, you'll get CAF value. Okay, this is the format, sir. Damn good format. This is must and should for us to understand. Okay. Okay, before going into the format, sir, once quickly. Here there are valuation rules, customs valuation rules. 1. Rule 2 talks about definitions. Rule 3. This method is applicable only when importer satisfies the following conditions. What it is? You can take transaction value as assessable value with some adjustments. What is called transaction value? Transaction value is the value transacted between two persons. Value transacted between two persons when they are independent, when they are not related, and there is no other consideration except price. So there are 4 conditions are here. The first condition is like, seller shall not have any control over the imported goods. Seller shall not have any control over the imported goods. So seller, he sold goods, now it's completed. He cannot tell me, he cannot put some conditions on me. Like you can use only this way, you can only stand and eat. Like that, he cannot tell me conditions. If he's inserting such kind of conditions, then the question is like, there may be a chance of price compromise. So we cannot take transaction value. So to take transaction value as assessable value, first one as valuation, customs valuation, seller shall not put any control once the goods are imported. Next, the price is not subjected to the such condition that for which value cannot be decided. Okay, the price is subject to some condition. So he's saying me like, I'll give for 50 rupees, but only you do this. Like that, he is putting some conditions. Okay, and if I do such condition only, he'll give me at 50 rupees or 60 rupees, whatever we agreed. Then that price is not an unconditional price, it's a conditional price, and we cannot find out the value for such condition. So then you cannot take transaction value, because transaction value should be a fair value. Okay, fair value. Next, third one, sale proceeds shall not be shared with the exporter. Sir, even though if you share also fine, but if you can find out exactly what amount you are going to share, then take transaction value. Next, fourth one, buyer and seller shall not be related. Buyer and seller shall not be related. So the points which I am underlying or else like which I am highlighting are important, sir. These 4 parts alone. These 4 lines important. You can take transaction value as assessable value. Only you cannot take when these 4 conditions are, you can take only when these 4 conditions are satisfied. What are those? Seller cannot put any control. Once I purchase goods, it's my duty. I can do whatever the way I want. Seller is, who is seller to put conditions on me? If he's putting such kind of conditions, we cannot take transaction value as assessable value. First one. Second one, once I purchased goods, further I am paying some 100 rupees. That itself is the price. Okay, I should not agree for some other conditions. Conditions now like it is something like, he is giving me for 100 rupees only if I buy some other different good also. Not only for this good. Let's say from Coca-Cola, sir, I am buying thumbs up. He is giving me at 20 rupees, but he is giving me at 20 rupees only if I buy Coca-Cola also. If that is the case, this point will applicable. Third one, sale proceeds. Once I purchased a good and I am selling for 100, 100, 200, 500, whatever the price, it's my money. I am getting. But if there is a clause like, out of the sale proceeds I get, if I need to share some amount with the exporter, you cannot take transaction value as assessable value. Then, or value here, buyer and seller shall not be related. 4 conditions or 4 conditions. If these 4 are satisfied, then you can take transaction value. Now come back to the format. This is our format. X factory price. I said na, question damn sure it starts with X factory price, not beyond X factory, not before X factory price. At least it would be with X factory price. Okay. For that, what you should add? Carriage, freight, insurance up to the port, and even export duty. This is only we are calling it as local freight, local insurance. Local na, don't think Indian local. Export country freight, insurance, and the local taxes if any, and even loading and handling charges, export duty. Sir, if you see the format, he is not differentiating FAS. Straight away they are coming to what? FOB. We can do like that only. Straight away to FOB. So add loading and all, you will get FOB. But you cannot take directly FOB. What you should do? From FOB, you should calculate FOB customs. From FOB, you should calculate what? FOB customs. How? FOB customs, the point to be included or given in Rule 10. Rule 10. So what are those points? First one. Commission and brokerage you should add. Except buying commission. Packing cost add. Except if it is a returnable packing cost. Returnable. I mean, once you return that packing material, he'll return you the material. Let's say, sir, I went to a grocery store, some store, and I purchased water 20 liters, and I don't have a container or a can to carry that. So he gave me that water can also and water along with it. For that, he charged me 140 rupees. 140 rupees. But once I bring that to home and I pour that water into some vessels which I'm having, and once I return the container, he's giving back me 100 rupees. So initially he took 140, but he's returning 100 once I return the packing material. So then the value should be taken is how much? 40 only. So packing cost you should add. But if it is not returnable, add. If it is not returnable, add. If it is returnable, don't add. Next, cost of engineering development has to be added. Royalty and license fee. Sir, when development designing, only when they are undertaken outside India. Then royalty you should add. Resale profits, if any, has to be shared. I'm selling for 100. Out of the 20, I need to give it to my exporter. Then add it. Then value of material which is supplied by the buyer free of cost. If I am giving any material to the supplier free of cost, add it. Inspection charges. Then this is called FOB as per customs. For this, we should add what? Freight. And then ship demurrage. Sir, there are two types of demurrages. But listen. There are two types of demurrages. What are those two types of demurrages? Those two types of demurrages are ship demurrage, port demurrage. Those two types of are what? Ship demurrage, port demurrage. Repeat with me. Ship demurrage, port demurrage. Ship demurrage is the penalty levied for delay in unloading the goods from ship. Ship demurrage you can add. But there is something called port demurrage. Port demurrage is like once the goods are unloaded and kept in the port premises, they are to be cleared within 30 days. Within 30 days. If you don't clear the goods from port within 30 days, then they will levy port demurrage. Then they will levy called port demurrage. So port demurrage, it is incurred once the goods touch the land. I mean after import completion, you cannot add. Ship demurrage you should add. Hello, clear? Then light dredge, I already said. The small boats used for carrying the goods from big ship to port. For them, if any incurred, that is called light dredge. Then you should add insurance. You'll get what? Cost, insurance and freight. Okay. Everything is clear, sir. Now, if freight is not given in the question, what we should do? If freight is not given in the question, what we should do? If the freight is air freight or sea freight, if it is not given in the question, air freight or sea freight, if it is not given in the question, take 20% of FOB customs, my friends. Sir, understand, not on FOB. It is 20% on FOB customs. FOB customs is what? The FOB with the 7 items which we add is called as FOB customs. You should calculate 20% on FOB customs. 20% of FOB customs. 20% of FOB customs. Air freight or sea freight. Sea freight, if it is given in question, take actual, buddies. Take what? Actual. If it is not given in question, then take actual freight or 20% of FOB customs, whichever is lower. If it is not given in the question, take 20% or whichever is lower. Then take 20% of actual freight. 20% of FOB or actual freight, whichever is lower. Very important, sir. Okay, actual or 20%, whichever is lower. Air freight, even though given in the question. Not given in the question, take 20% of FOB customs. Sea freight, given in the question, take actual. Not given in the question, take 20% of FOB customs. Clear? Next, what is clear? Okay, guys, how that Josh, man, listen with Josh. Don't listen to the class with that sleepy face and all. Okay, if you are in class I'll not even encourage you listening to class in such a sleepy mood and all. Where is the Josh? You should be high always, as if you have taken cocaine. You can look at me. I'm having Josh only. Now I'm telling the class with Josh only. Now you should also listen the class with that Josh energy, that high kind of feeling. If you are having, then the subject will also come, man. Listen to me, okay? Listen the class with Josh. Practice the class with Josh. Study with Josh. The Josh pushes you little better, okay? Insurance. An insurance is not given in the question. Take 1.125 percentage of FOB customs. These are must and should, sir. Even though question is silent about freight and insurance, you should take as if it was not mentioned in the question. If no freight is mentioned in the question, take 20 percentage of FOB customs. If insurance is not given in the question, no clue also, then take 1.125 percentage of FOB customs. Then if it is given, take actual. If it is given what? Take actual. Hello. Clear? Then here I need something, sir. There is something called relevant for MCQ, sir. Sir, we can solve problems, but these 2 points, if you are following my material, page number 13.5, interrelated, these 2 points, sir. Sometimes in question they give FOB customs plus insurance, they'll give as $10,000. You don't know FOB individually, you don't know insurance, you don't know individually. Freight they will not given in the question, and you need to calculate freight. How you will calculate? Don't worry. Generally, we should apply 20 percentage on FOB customs now, but there is a proviso here which says like when you cannot find out FOB value individually, you know only the combined value of FOB customs and insurance, then apply 20 percentage on FOB customs plus insurance. Okay, when you don't know FOB value, sir, this is a proviso point. Only in exceptional cases it will come. When you don't know FOB customs value individually, and if you know only together value, this value only you know, this value only you know. In such cases, you should take what? 20 percentage on FOB customs plus insurance. Okay, the same way, if they gave FOB customs plus freight. They gave what? FOB customs plus freight. FOB customs plus freight together it is $10,000 given in the question. You don't know insurance individually. What to do? Then apply 1.125 percentage on FOB customs plus insurance, whatever plus freight you are having now on this only. So on this $10,000 only, you should apply 1.125%. Here on this 10,000 only, apply 20%. Don't apply your max and all. Okay. Don't search for logic here also and waste your time. Okay. In regular class now, I might have at least tried to explain you this much more clearly. Some students, even I felt it was somewhat logicless when I'm studying this thing. But it has a logic, but I don't have time to explain now. And you also don't have time to understand now. Okay. This is what. Clear now? So let us go and solve the problem, sir. Quickly. No time we are having. Question number 7, sir. This is question number 7 from types of duty, page number. If you are following my book, C 1.6, customs 1.6, page number. Compute the assessable value and the total customs duty payable under Customs Act for an imported machine based on the following information. Cost of the machine $20,000. Cost of the machine at the factory of the exporter. What it is? X factory price. Transportation charges from the factory to the port. Where, sir, it is incurred? Foreign country, 800. Add. Handling charges, 50. Add. Okay. Then buying commission will consider or ignore? Will ignore. Light rate charges, freight incurred, ship demurrage charges, freight charges, and date of entry inward and all. Okay. Let us solve this problem together. First, take X factory price. What is the X factory price given in the question? X factory price 20,000. We should add what? Local freight now, not which incurred in India. Foreign country. How much is the freight there? 800. Then we should add what? Handling charges. handling charges. Handling charges how much, sir? 200. If you add this two, you'll get what? FOB. How much it is? 21,000 is the FOB. But we should what? We need what? FOB customs. We need FOB customs. For arriving FOB customs, do we have any of the 7 items? Commission and brokerage. Sir, commission we are having, but this is what buying commission. So ignore this one. Do we have designing charges? I don't find anything here. Designing charges and all. Okay, no designing charges. Third one, sir. Do you have any packing cost here? No packing cost. Do you have royalty and license fee? No. Do you have any inspection charges? No. Any free of cost material supplied? No. Any sale profit shared? No. So nothing is there now. So this itself FOB, and this only the FOB customs as well. Clear? 21,000. Now we need to add what? Freight. We need to add what? Freight. What is the freights are here? Freight incurred from port of entry to inland container depot. Sir, understand, inland container depot na warehouse. Port of entry means already entered into India. Once it is entered into India, then it incurred freight. After entering into India, it incurred freight. This freight need not to be added, this 1,000 rupees. But this 5,000 we should add. This 1,000 is from Australia or whatever the exporting country to India. This we can add. But this 1,000 rupees is incurred in India. Once the goods reached India, that we cannot add. Light rate charges we can add. Ship demurrage charges we can add. Insurance, did they mention anything about insurance in the question? No. But we shall not forget, we should add even insurance. So first add what? Right. Given in the question. Sir, we are not sure whether it is air freight or sea freight, but I can tell it is the sea freight only. How? Here this mentioned it as ship demurrage. So you should add freight 5,000. Then insurance not given in the question. What you should do? 1.125% of 21,000. If you do now, you'll get some amount. How much you got? 234.5625. 234.5625. Add. Then add ship demurrage. Sir, I already said demurrage is of two types. Port demurrage we cannot add. Ship demurrage we can add 400. Then light rate charges. Small boats related charges. What is the small boat related light rate charges, sir? 200. Add. After adding all this, you will get what? CAF value. What is the CAF value, sir? Total. If you do how much, sir? The total is 26,684. 26,684.5625. Now this is in dollars, sir. We need to convert into Indian rupees. How? Which rate, sir? Again, go back to types of duties chapter. I said very, very, very important, that is exchange rate we should take given by the CBIC. Exchange rate we should take the exchange rate given by CBIC as on the date of submission of bill of entry. Exchange rate as on the date of submission of bill of entry. What is the exchange rate, sir? That day 60. Whereas BCD rate, bill of entry or entry inward, whichever is latter. Which is latter, sir? 25th Jan, 20th Feb. 20th Feb only latter. So BCD 20% only we should take. So convert it into using, what is the exchange rate? 60. If you convert it using 60, how much you got, sir? 16 lakh 1,000. Accessible value is 16 lakh 1074. Now the past chapters are again. You should levy BCD at what rate? 20%. Then on this social welfare surcharge at a rate of 10%. Are there any other duties given in the question, sir? No, only IGST 12%. So okay, you do subtotal here. After levying BCD and social welfare surcharge, you do subtotal. Then on this you levy IGST at a rate of 12%. Let me show you the question answer here. So see, on 16 lakhs, this fellow levied BCD 20% on 16 lakh. Then social welfare surcharge on 3 lakh 20. Then balance subtotal we call it as 19 lakh 53. Then IGST at a rate of 12%. Total value this one. How we calculated the total customs duties are find out. Total customs duty is BCD, SWS, IGST 1, 2, 3. 3 lakh 20. 32,000, 2 lakh 34, this thing. If you add this, you got 5 lakh 86,633. This is the total customs duty needs to be paid. And the ITC available is this 2 lakh 34,397 can be taken as ITC. Hope you are able to understand, sir. Let me solve one more problem for you, sir. Okay. ABC Technologies Limited has imported certain equipment from Japan at a FOB cost of 2 lakhs. The other expenses incurred in this connection are freight from Japan to India 20,000 and insurance 10,000, designing charges 30,000, has expended 1 lakh for certain development activities. Sir, freight from Japan to India, fine. We can add. At what place? Secondary. We can add. Insurance, yes, consider. Designing charges paid to consultancy firm in Japan. Designing outside India, we can. Technology has expended 1 lakh in India for development activities. 1 lakh development activities where, sir, in India shall not add. Had incurred road transport cost from Mumbai to their factory. So this is post importation cost. Post importation. After the import is complete, this expense has been incurred. We cannot add. CBIC exchange rate 0.3948. Okay, what the actual payment rate and all is not required. CBIC rate only required. The commission payable to India in agent was 5% of FOB. Sir, it is paying in India, na, can we add? What I said, commission blindly add, except if it is buying commission. How can I know whether it is buying commission or not? You don't worry. If it is buying commission, they will clearly give in the question stating it as buying commission. If nothing is mentioned in the question, don't assume yourself as buying commission. So this we can add. Okay. So first, they took free on board FOB value, then designing charges added, development not addable, road transportation not addable, commission added. After adding commission, you got what is the FOB value, sir? 2,40,000. Okay, you convert into Indian rupees, you got 94,752. Then the FOB customs we arrived, sir. For FOB customs, we should add what? Insurance and freight. Insurance they given in the question, sir. What is the insurance given in the question? 10,000. Somewhere I saw. This is the 10,000. And freight they given 20,000. Insurance given in Indian rupees, sir. Whereas this freight is given in yen. So yen needs to be converted into Indian rupees 7,000. So if you add, you got the accessible value. You got the accessible value. One more question for you. This one. BCCA have imported a machine from the following particulars furnished by to arrive the accessible value for the person. FOB, sir. They gave directly FOB, sir. 10,000. Very easy for us. Freight they given engineering. Engineering and designing outside India. So add. License fee 20% of FOB. Add. Materials and components supplied free of cost. Add. Insurance we shall add. Buying commission. Macha, it is what? Buying commission. Can we add or not? No, we cannot add buying commission. Ignore. Okay. And they gave interbank rate not required. CBIC car rate 70.25 required. And importer paid 5,000 towards demurrage charges for delay in clearing the machine from the airport. Sir, from airport, that not ship demurrage. This is port demurrage. We shall not add this. We shall not add this. So first this fellow take FOB. Then added engineering and designing charges, license fee. You got 12,500. Okay. Then subtotal. Then add, actually is using the word subtotal, but you cannot add do that. Then add material supplied by the buyer freely. After adding that, you get what? FOB customs. FOB customs is what? 8,98,125. For that air freight. Sir, question it is given air freight. Whenever it is air freight, what we should do? Actual or 20% of FOB customs, whichever is lower. Actual or 20% of FOB customs, whichever is lower can only be added. So what is the lower here? Actual is 3,000 USD into 70.25 or 20% of 8,98,125, 2,10,750. Whichever is less, na, it is 8,98,125 into 20% only, which is 1,79,625. And insurance, I think it is given in the question. Insurance, yes, it is given in the question 6,000. So add directly that 6,000. You got the accessible value or CAF value. Okay, are you able to follow? Hello. If you have any doubt, pause the video here, go back, listen to the format which I said once again, try solving the problem 1 or 2 times on your own. You'll definitely remember this thing. Okay, friends, now we are into the other rules. Okay, now we are into the other rules. Quickly we get finish off. Hang on with me. Okay, don't go anywhere. If I don't do this kind of things and all, if I'm telling the class at normal pace now, it's not engaging for you, I think. So now rule 3, sir. Rule 3 is done. I said 4 conditions. Only when 4 conditions are satisfied, we can take transaction value. What are those 4 conditions? Supplier and buyer shall not be related. Okay, there should not be, the supplier shall not put conditions over the goods which were imported. Third one, the importer shall not be sharing the sale proceeds with the exporter. Next one, there should not be any condition to sell for which we cannot exercise monetary value. So those are the 4 conditions. What if because of those 4 conditions we cannot take transaction value? Then we are having rule 4, 5 and all. Rule 4 says like take transaction value of identical goods. Identical goods na, so these two are identical goods, sir. Identical goods means they look like same, look like almost same. The better examples than these are like Thumbs Up and Coca-Cola. Thumbs Up and Coca-Cola, they are almost look like same. So they look like same, including in physical quantity and all. Okay, so what they are saying na, if I imported a good, sir, this value we cannot take because maybe me and the supplier are related. So for this good, there may be identical good na, find out that identical good import value, accessible value, that you take it as accessible value after adjusting the minor adjustments if any, and take that as the accessible value. Goods, identical goods means they are almost same and they should be coming from the same country which I imported. Let's say I imported this Hero Splendor from Australia. You cannot compare some good which is coming from Japan. The identical good also shall be coming from the same country. If possible from the same person. If not same person, it's okay. But at least it should come from the same country. Okay. Next. Value of imported goods is transaction value of identical goods shall be the value of imported goods. So our goods value we cannot find out. So you take identical goods value and adopt it as your value. Fine. But the problem is, sir, there are multiple identical goods. Multiple identical goods. Now for Hero, it's not only Glamour. There is Honda Shine. There is Bajaj Pulsar, which are almost the same identical goods. So there are multiple identical goods. Which value I should take? If there are multiple identical goods, if more than one value of identical good is available, take lowest of such value. Lowest of such value has to be taken. Lowest of such value. Okay. Then similar goods. What are similar goods? Similar goods although does not look like same but perform same functions. Does not look like same but does not have like characteristics like all aspects, but they'll perform the same functions and to be commercially interchangeable. So if you see Fascino and Bajaj Pulsar, they doesn't look like same. We call them this we call as bike, this we call it as scooty. They are different, but they perform same functions. Both are used for transportation. Now one guy from comment section will say like, sir, auto also can be used for transportation. Sir, it is also similar good. Day, best fellow, listen here. These two goods are meant for transportation of 2 passengers and both of them are 2-wheelers. Okay, whereas auto is a 3-wheeler and carry more passengers and all. So don't bring such kind of interpretations and all. Okay. Then what is the value? If the value of identical good is unacceptable, then use transaction value of similar good. Sir, if identical good is available, then take identical good value only. Identical good not available or identical good we cannot take, then take similar good value. Multiple similar goods, what we should take? If more than one value of similar good is available, take lowest of such value. Take what? Lowest of such value. So difference between identical goods and similar goods. Goods must be same in all aspects except for minor differences. Identical goods. Goods have like characteristics and components and perform same functions. Then they are similar goods. Example, Hero Honda 2-wheeler, Splendor and Passion. Here Hero Honda Splendor and Bajaj scooter. Okay. Clear? So quickly we'll solve a problem on this. A consignment of 800 metric tons from Malaysian origin was imported by a trust. Since it is a special transaction for charity, they were imported at $10 per ton. $10 per ton. Okay. Was charged. The customs office find out that these are not acceptable, sir, because This is charity. Here the other point why it is coming for 10 the other reason is charity. For that we cannot find out value. So you cannot take transaction value 10 as accessible value. Then what you should do? Go for rule 4. What rule 4 says? Find out if any identical goods are there and the value of that identical goods only we should take. The value of that identical goods. 20, 100, 500, 900, 400, 780. So there are multiple identical goods, sir. Multiple. These are the following imports. So there are multiple identical goods. If there are multiple identical goods, which we should take lowest of value. What is the lowest of value? 160. Take this. Okay. And what is the exchange rate? 63. So actual our consignment is 500 tons and take per ton as 160 and convert it into Indian rupee 63. You'll get how much? 80,64,000 on that BCD, SWS, total custom duty. Here they said no IGST. That's why they didn't calculate IGST. Hope you are understanding now. If more than one identical good are given, we are supposed to take the lowest of that quantity, price of the quantity which is near to the quantity of import. Fine. Then for similar goods, there is no problem in our material, sir. Then rule 6. What rule 6 says now? Acha, you went and checked rule 3 na? Yes. But there some conditions are said. Those are not satisfying. So I cannot take transaction value as accessible value. Okay. Did you went and checked rule 4? What is rule 4? Identical goods. No identical good available. Even though identical good available, that also from related people only transacting. So we cannot take that value also. At least similar good. Yes, similar good is available, but same, that similar goods imports are also usually from the related persons only. So we cannot take our good value, our imported good value, identical good value we cannot take, similar good value we cannot take. Then what's the option we are having? Rule 6 says like it is giving you motivation here. Don't worry. Rule 3 fails, go rule 4. Rule 4 fails, come to rule 5. If all the 3 you cannot apply, then there is rule 7 and 8. Go and check rule 7. If rule 7 is also doesn't work, then go to rule 8. That's what rule 6 says. Rule 6 does not tell any method. It tells just to go to rule 7 and rule 8. Now what is rule 7? Rule 7 is deductive value method, sir. Deductive value method. What is deductive value method? Sir, I have an imported good. This import price I cannot take because compromised. Because those 4 conditions are not satisfied, it is compromised. I have identical goods. This price also you cannot take. Why? They are also not fair values. They also compromised. Like from related person only. Similar goods. For them also import price I cannot take because their price also compromised. Then what they are saying now? This imported good if sold in India, after import you will sell it for in India na, sale price in India. Take that. Sale price in India na, take that. Sir, I will not sell the good as such, sir. I will do some processing and all. I will not sell the good which I imported. I'll use it as a raw material, sir. I will not sell directly. Okay, then this doesn't work. Okay, then identical good sale price find out. At least not your good sale price, identical good sale price. So that also not available. Then at least similar good sale price. Okay, so this method says like take the sale price, from sale price will subtract sale price na in India at some outlet they are selling na, from that selling price you will subtract the expenses which were incurred after importation. After importation, whatever the expenses incurred, you will be subtracting and taking them back till the port place. Okay. So example, sale price. From sale price, you subtract, sale price is 5,000, sir. From there, you subtract selling and distribution expense, 1,000. Then you subtract profit. Profit will be there, na, 1,000 subtract. And there is freight. Freight na within India, sir. From the port to sell the shop and all, you will incur freight na, that 200. And customs duty also might have been included in this. Subtract the customs duty which is included, 500. After subtracting all this, you will be getting like 2700, if you subtract, you will get how much? 2300. This you take as accessible value. This method is deductive value method. From the sale price, subtract the post importation expenses once import completes when the goods touch Indian land. From the point it touch Indian land, what are the expenses incurred till the point of sale? Those expenses you should subtract. Then you will be going backwards. From ex-factory price way, if you are coming now, you are coming like in a forward way. Everything you are adding and coming till the port place. But now, from the sale price, you are coming back to the port gate, to coming back till the place in the port of, or the place of importation. That price is called as deductive value method. Deductive value method. Okay. See, deductive value. The value of imported goods shall be based on the unit price at which the imported goods or identical or similar goods sold in India. At the same time, in the greatest aggregate quantity at which the highest number of units are sold, that amount you should take. Okay. For sale price, profit, selling expenses, selling commission, cost of transportation and insurance, customs, all this you should subtract. Greatest aggregate quantity, the price at which highest number of units are sold. The price at which highest number of units are sold has to be taken. Okay. Now, quickly we'll solve problem as well on this. So, see, X Limited imported 500 units of minerals from High Seal, selling price exclusive of duties and taxes. Freight from port to depot in India is 10,150 and insurance is 1,250. High Seal sells, we cannot find out the selling price. So, there are identical goods. One lot 400, 300, 150, 500. Okay, different prices. What they are saying, take the price at which greatest aggregate number of units are sold. The price at which greatest aggregate number of units are sold. So at 90 rupees price, how many units are sold? At 90, 300 plus 350, 650. At 100, how many units are sold? 550 units. At 95, how many units are sold? 500. At 105, how many units are sold? 250. So at what price greatest number, highest number of units are sold? 90. So you should take 90. What is the actual number of units we imported? 500. So 500 into 90, it would be 45,000. From 45,000, you should subtract this freight, insurance, customs duties and all not there, because here they said selling price exclusive of duties and taxes. So you should not add them. So 10,150 and insurance, if you subtract, you will get the assessable value as 33,600 on that levy BCD. Where is the BCD rate, sir? It is 13 points, sir. 12% BCD. SWS at a rate of 10%. Together he got 4,435. Okay. Clear? Okay. Then the next sums are computed value method. Sir, computed value method. Computed value method, sir. This is when means all the other methods failed. Here what we do means will not do all these things and all. Here the ex-factory price also not known. The supplier also doesn't know what is the price and all. So for him only will calculate price. For supplier himself will take his material cost, expenses, all those things will take, and will add some reasonable profit as well, and will add all the other expenditures. That is called as assessable value. Very low. You cannot even expect a question from this, sir. But just it is there in syllabus. I am just covering. The value of import goods should be based on computed value. Computed value, cost of value of materials, profit and other expenses. If you add materials, profit and all other expenses, you will get the assessable value. Fine. Then rule 8 is also not there, residual method. They have suggested so many methods till now. None of the method is working for you. Then what else they can do? They're saying like, you go, you do whatever the way you want and come to me. Okay, it's the best judgment method. This method is applicable when all the aforesaid methods are not applicable value. Okay, then rule 10 I already explained, sir. While discussing the format, 7 items we are adding now, that is nothing but rule 10. Declaration. Whenever the goods are imported, importer has to give a declaration that he has accurately given the value, and all the invoices and documents given are proper fair documents only. Like that, he should give a declaration. And the customs officer can reject the value which we declared. Okay, he has always the option to reject our value, but he cannot reject it outright. Whenever he is having a doubt regarding he is having questions regarding the value which I have mentioned, he should give us a reasonable opportunity of being heard. He should give us a opportunity. Only on giving an opportunity, even after our explanation, if he is not convinced like what we did is proper, then he can reject our value. This is about the customs total. Okay, I hope you have enjoyed this customs lecture. Like, comment, subscribe, share. Hello all, welcome to GST introduction chapter video. Sir, many things introduction I will not listen and all, but introduction very important for CMA inter students. Even in the intro video I said this, even now also again I'm saying the same thing. Intro, very important introduction chapter here. The current trend is they're asking 2 7 marks questions. 2 7 marks questions, you're getting 14 marks. Okay, but still you feel like, sir, I know this, I have studied already first chapter, I'm so good at first chapter. Please keep your overconfidence aside and spend this 2 hours. Literally, you'll get that benefit by watching this one. Okay, first listen, at least for 2 minutes you listen, then you think of it. Sir, this is my material, sir, actually. Okay, this is my material. First chapter, if you see, I have hardly 1 2 3 4 and 5 pages. This is what I have first chapter. I'll explain this, but in class I take so much time to explain this. But the problem is, if you look at the benefits of GST, this is what I have in my material. And they're asking this kind of questions constantly, regularly in new syllabus also. But when I checked the MTPs, look at the benefits, how they are asking. If you look at the benefits here, you're having so many other benefits. You could see 1.5 page related benefits we are having. So it's not the same. So what I'm doing specially in this marathon means, we have identified while doing EO sessions for our students that from first chapter there are 2 7 marks questions. Means if you are writing the classroom discussion, either me or any other faculty related also, okay, this one thing, sir, you should understand this. We'll try to cut short the question and explain in classroom. But if 2 questions are coming, maybe I'm thinking like, why you are not getting good marks even after you knowing all the questions? Means what I thought means, maybe institute is expecting a little more here. That's why I have identified the mock test paper and suggested answer questions. We are having hardly 8 questions here. These 8 questions are only repeating again and again repeating. So we are having a fair chance of getting those 2 7 marks questions from this itself. Okay, so now what I am doing now, first chapter I'll cover in the usual way, but whenever this topic comes, I'll not discuss in my material, I'll discuss in this one only. Now some students will ask, sir, where do I get this PDF? So this PDF, now this is the separate PDF, sir. You'll have some 8 pages, which is nothing but the mock test paper and suggested answers related questions from first chapter which are being asked. Okay, those and all we have taken here. So this is available in our BCCA app in free resources. In our BCCA app, this is available. You can download it from there. Fine. Okay, now before going further, sir, first we will discuss the differences between direct taxes and indirect taxes, and let me take it further. So comparison between direct tax and indirect taxes. The payer of tax and the sufferer of tax are one and the same in direct tax. It means I only pay the tax and I only have to pay it from my pocket. So I'll only pay and I'll only suffer. Payer and sufferer are same. But coming to indirect tax, payer of tax and not sufferer of tax is not the sufferer of tax, whereas sufferer of tax is not paying directly to the government. Okay, for this you need to understand this one. Look at this, how the mechanism in IDT work. There is a seller, he sells goods to a buyer, and collected tax from him. So now buyer has to pay good value 1 lakh and even the tax 12,000. Total he'll pay 1 lakh 12,000. Now the obligation to pay to tax to the government is with seller. There is a burden of tax. I mean the suffering is on buyer. Okay. So now you could understand this one. Okay, the payer of tax is not sufferer of tax, whereas sufferer of tax is not paying directly to the government. Next, direct tax is income based tax. Income based tax na direct tax is levied only when you are having income, whereas indirect taxes is a supply based tax. Whenever you have a sale, transfer, exchange, barter, such kind of transactions, then indirect tax will be levied. Next, rate of taxes are different from person to person. Under direct taxes, the rate of taxes are different based on your income slab. 2.5 lakhs, 5 lakhs, 10 lakhs. If it is optional slab rate, it's not optional, I guess, no. Like they're also 5%, 10%, 15, 20, like that. The tax rates are differing from person to person. But whereas indirect taxes will not differ from person to person, they are constant for every person. Irrespective of your rich and poor, you will be taxed at the same rate. Next, entire revenue goes to central government. The direct tax revenue wholly goes to central government, whereas indirect tax revenue will go to central government as well as to state government. Next, in income tax, there is concept of previous year and assessment year. That means this year income will be assessed to tax in the coming year. But whereas such concept is not there in indirect tax. There is no previous year and assessment year concept in indirect taxes. Next, CBDT is the administrative body in direct taxes. CBDT, Central Board of Direct Taxes. So it is the important part. It will take care of the administration. Whereas CBIC under indirect taxes, CBIC is the administrative body. CBIC means Central Board of Indirect Taxes and Customs. Central Board of Indirect Taxes and Customs. It takes care of the administration. Direct taxes are progressive in nature. Indirect taxes are regressive in nature. See, sir. It's a proper 7 marks question. He'll expect 7 differences from you, and these are the 7 differences which the examiner may check. Okay, sir, I also used to tell in the normal way, but I observed this and I'm sharing with you these points. So don't neglect this point. 2 7 marks questions are, and which everybody will usually try to attempt. From a 7 marks question, if you just make an attempt and if you write whatever you get now from 7 marks, if you secure only 3 marks, it's of no use. Okay, you are just simply wasting these questions and all. So there are fair chances of getting questions from this. So I am asking you to do this and I'm asking you to find out this. Okay, now let us discuss little concept and again we'll come back to the questions as well. This is the concept of indirect taxes. You understand now? It's okay. Now progressive in nature, regressive in nature. Next, India definition, sir. India includes 28 states, sir. All the 28 states, and even there are 8 union territories: Puducherry, Andaman Nicobar Islands, Lakshadweep, New Delhi, Chandigarh, Dadra and Nagar Haveli, Daman and Diu, Jammu and Kashmir, Ladakh. So there are total 28 states and 8 union territories. But out of these 8 union territories, 3 union territories, Delhi, Puducherry, and Jammu and Kashmir, even though they are union territories, they work like state government. So for the sake of GST, we'll have 31 states and only 5 union territories. For the sake of GST, if it is a general knowledge question, there are 28 states and 8 union territories. For the sake of GST, there are 31 states and 5 union territories. Okay. Now we should understand this federal structure. Federal structure, na sir, in every, I mean, how the composition of government is there in India. So we have central government, state government, union territory, and even local authority. 3 layers or 3 different structures of government. These 3 are not dependent on each other. There is no hierarchy like local authority on their top, state government on their top, central government. It's not like that. Okay, all the 3 are independent. They can function independently. They could even generate revenues on their own independently. So state government, central government have power to collect taxes on certain items. State government has the power to collect taxes or levy taxes on certain items, whereas local authority also has the power to levy and collect taxes on certain items. They are independent transactions. Okay. Now, before going further, sir, we'll understand what were the taxes that were there in indirect taxes before the introduction of GST. I'll take and discuss this question even in the mock test paper. First here, They are central sales tax. Central sales tax. Central sales tax is to be levied by central government on interstate sale. Interstate sale. So now we should understand what is called interstate and what is called intrastate. When seller and buyer are in two different states, or two different union territories, or one state and one union territory, then we call it as what? Interstate. If it is an interstate transaction, seller in one state, buyer in another state or another union territory, or one state, one union territory, then we call it as interstate. Before GST, when there is a sale transaction, and if it is an interstate sale transaction, then the government used to levy which tax, sir? Central sales tax. And this central sales tax is levied by state government, and the reason is interstate sale. Next, there is something called advertisement tax. Advertisement tax is levied by state government on advertisements. Next, luxury tax is levied by state government on luxury goods. High-end cars, cosmetics, okay, those kind of luxury goods, state government used to levy luxury tax. And there is something called lottery tax. Lottery tax is levied by state government on sale of lottery tickets. Sir, it's not frequent or regular in Andhra and even in northeastern states as well. But if it in Kerala, if you see, lottery is most common thing, sir. You could find so many shops selling lottery tickets and all. So lottery tax is levied by state government on sale of lottery tickets. Next, there is something called octroi tax. Octroi tax na entry tax, to allow a person from some other state to come and sell goods in this state. Let's say in Andhra Pradesh, if you are allowing to allow a Maharashtra person to come and sell goods in Andhra Pradesh, they used to levy entry tax or octroi tax, which is levied by state government when seller from other states selling goods. Next, there is something called VAT, value added tax. State government, it is levied by state government on intrastate sale. What is called intrastate sale? When they are in two different states, when the seller and buyer are in two different states, two different union territories, or one state and one union territory, we call it as interstate. When it is interstate, when they are in same state or same union territory, then we call it as intra. We call it as what? Intrastate. On intrastate, previously there used to be VAT, value added tax, and even it can be called as sales tax. Then entertainment tax. Entertainment tax is levied by state government, on entertainment activities such as movies, these amusement parks. On those entry tickets, entertainment tax is to be levied. And there is another, sir, there are two types of entertainment taxes. In certain places, entertainment tax will be levied by state government. At certain places, entertainment tax is levied by local authority. Why I need to differentiate it, you will understand. Wait for a minute. Then excise duty. This is central excise duty. Central government will levy excise duty on manufacture of goods except alcohol. On manufacture of alcohol, state government will only levy state excise duty. Except on alcohol, on manufacture, the central government used to levy excise duty. And on sale of services, there used to be service tax. Central government, it will be levied by central government on sale of or on providing services. Okay. And few important points are which you need to understand here is like, here, even on introduction of GST, excise duty continues to be levied even on tobacco. Even on introduction of GST, excise duty continues to be levied. Okay, I'll show it in my material, sir. See, these are the taxes now. Union government have also retained the power to levy excise duty on tobacco products even after introduction of GST. Same way, entertainment tax, two types I said na. If it is levied by state government, subsumed into GST, merged into GST. If the entertainment tax is levied by local government, levied by local authority, it is not subsumed into. Levied by local authorities is not subsumed into GST. In the same way, state government also has retained the power to levy state excise duty on opium, Indian hemp, drugs and all. State government continues to levy excise duty, state excise duty, even after introduction of GST. Okay, so these are the taxes subsumed into GST. For us to remember, I have a code, CLOs. What does it mean? C for central sales tax, A for advertisement tax, L for luxury tax, O for octroi tax, and another for L for, okay, L square, L for lottery as well as luxury. O for octroi tax, V for VAT, E for excise duty, and S for service tax. Okay, so now we'll check in MTPs. We have this question even in MTPs as well. MTPs, sir, this is past compilation, sir. MTPs, RTPs, everything. Okay. Enumerate any 7 state taxes which are subsumed into GST. State VAT or sales tax, central sales tax, purchase tax, luxury tax, entry tax, entertainment tax, advertisement tax. You could even write lottery tax. Okay, these are the taxes which are subsumed into GST. You're quite comfortable now, sir. We are only having how many? 6 is 7, 8. There is 8. There is double time duplication, sir. So totally 9 questions only, sir, from first chapter. I'm again repeating, sir. Even though you have read from your material which is comfortable to you, but download this soft copy and try to read from this. Why I'm asking you to do that means it is very important to do that, because 8 questions, if you read this and if you try to recreate this content, the chances of getting 6 marks out of 7 is very easy. So don't forget to do that. Next, we should understand the concept of double taxation and cascading, sir. Before going further, this is my basic job, sir. Whether I start marathon, whether I start a UO, whether I start a regular batch, I cannot proceed further without explaining you double taxation and cascading. See, there's a manufacturer. Cost 900, margin profit 100, and the selling price is 1000. On this, assume the indirect tax levied is 100. The total invoice price came to how much? 1100. Now it was sold to wholesaler. Wholesaler cost, assume there is no concept of ITC. The wholesaler cost is how much? 1100. On this, add wholesaler margin 100 and the selling price is how much? 1200. On this, levy indirect tax of 120 rupees. Overall it came to 1320. Overall it came to how much? 1320. Cost 900, margin 100, the selling price is 1000. The selling price is 1000. The selling price is 1000. Okay. After adding this 100 rupees of indirect taxes, the invoice price will be 1100. Now, wholesaler, when he purchases, whatever is the selling price to manufacturer will be the cost to wholesaler. On this, he added his margin and now his selling price is 1200. Now the tax is levied on this 1200. Now the tax is levied on this 1200. Understand here, sir, very clearly. If you are levying tax on this 1200, this 1200 is nothing but this 100, this 1000, and this 100. This 1200 is nothing but this 100 which is added by wholesaler, and the manufacturer stage selling price 1000 and the manufacturer stage tax 100. After adding these three only, we got 1200. Now if you levy tax on this 1200, again this 1000 is getting taxed once again. If this 100 is tax only, on tax itself you are again levying tax. So understand, on this 1200, if there is again tax, then that is called as what? Double taxation. If there is tax levied on this 1200 once again, then that is called as what? Double taxation on 1200. If you are levying to the extent of 1000, there is double taxation. To the extent of 100, there is cascading effect. Okay. So now understand the concept of ITC. What is ITC? Whenever you have an inward supply, let's say this buyer recipient is having a laptop, on that IDT 12,000 paid, overall 1,12,000 is the purchase price including tax. On this he got IDTC. ITC is something, the tax we paid on purchase will be given back to us as ITC. So the ITC is getting back is 12,000 if he is a registered person. So this ITC 12,000 you can use it while paying the tax on his outward supplies. On purchase, whatever the tax you suffered, you can avail it as ITC. On purchase, whatever the tax you suffered, you can avail it as ITC. And such ITC can be used. Such ITC can be used to discharge the tax liability on your outward supplies. Such ITC can be used to discharge the tax liability on your outward supplies. Okay. Now look at the same example after ITC. Cost 900, profit 100, selling price 1000. IDT 100, 1100. Now, even though it is sold to 1100, but in 1100 there is 100 rupees tax na, that was taken as ITC. Now, after ITC, the cost is 1000 on this 100. The selling price came to 1100. If on 1100 you levy tax 110, you are asking me like, sir, from 120 with ITC also it came to only 110 only, na 10 rupees only decrease na. No, understand. This 110 you will not pay. This 110 you will not pay. What you will do while paying this 110, you will adjust the ITC whichever you are having 100. Effectively you pay to government how much? Only 10 rupees. Effectively you pay only 10 rupees. That means only on the value addition, only on this 100 rupees value addition is there na. On that only tax is there, not on the whole amount. Only on the value addition tax has been levied. So with the concept of ITC, double taxation will run away. Cascading effect will also run away. You understanding na? ITC is introduced with an intention to eliminate double taxation, to control, to mitigate double taxation. Okay, so here double taxation. How? Whatever, close your eyes and listen for 1 minute. Whatever the tax you suffered on your initial stage of purchase will be given as a rebate or refund kind, will be given as a rebate kind of, which you can adjust when you are paying tax on your sales. So the prior period taxes, the prior period taxes is eligible for set off in the subsequent period taxes. So 100 you paid initially, subsequently if you paid 120 na, you will not pay 120, you will pay only 20 after adjusting this 100, after adjusting the initially paid 100. So additionally you are paying only 20. That is the concept of ITC. The taxes we paid will be given as credit on inward supplies. The tax paid will be given as ITC, input tax rate, that we can use for discharge of tax on our outward supplies, that we can use to discharge the tax on our outward supplies. Clear? Okay. Paka. The tax paid on previous stage will be allowed as set off while paying tax in the current stage. Okay. Now we are understanding the questions are need for GST, but I am not explaining from here. I'll explain from the MTPs only, because there is such kind of question, need for GST. And this one only, sir. The difficulties and limitations in pre-GST regime in the context of indirect taxes which were removed with the introduction of GST. Nothing but the problems in the pre-GST regime. First one, in pre-GST regime, Indian indirect taxes was highly fragmented. Central and states were separately taxing the goods and services. There were many taxes like excess duty, service tax, VAT, CST, purchase tax, entertainment tax, octroi. Sir, fragmented na, it was into so many pieces, bits and pieces. Okay, it was scattered. So many taxes are there pre-GST regime, with out of them some are levied by central government and some are levied by state government. So that is the problem. Indirect tax is not a single tax, just like as direct tax. Indirect tax, income tax is the only tax, but in indirect taxes there are so many taxes. It was fragmented. Now it was divided into so many branches. You understand? Purchase tax, VAT, CST, service tax, excess duty. So that is one limitation in pre-GST regime. Because of GST, by introducing GST, all these were subsumed and made it as one tax. That is one problem. Next. In addition, not only having multiple taxes, even with multiple taxes, there used to be multiple rates, multiple laws, multiple procedures. This caused heavy compliance burden. Compliance burden, sir, when a rule is kept, to follow that rule, we may incur some cost. Let's say the traffic rule says like we should always wear a helmet. So to buy that helmet will incur some cost. That is compliance cost. Next, Companies Act will say like every company has to get their books of accounts audited. For that reason, they need to appoint an auditor. The cost for auditor is nothing but a compliance cost. So in pre-GST regime, the total indirect tax system was highly fragmented. So central and fragmented. Central and states were separately levying taxes on goods and services. There are many taxes like excise duty, service tax, VAT, CST, purchase tax, entertainment tax, octroi, etc. But, and even the second point is what? Not only just multiple taxes, even there is multiplicity in laws, rates and procedures. This caused a heavy compliance burden, because if you train employee related to VAT, he only learned VAT. He cannot do excise, he cannot do other taxes as well, because there are so many. He'll get confused. But under GST, one law only na. If you train your employee or someone, that itself across the India, or that itself for any kind of good or service, so that made easy. Next, imposition of tax on tax. Tax on tax. Tax on tax na, nothing but cascading. Nothing but cascading. Previously, sir, I'm writing here, when let's say for example, a car was sold by Tata Motors for 10 lakhs previously before GST. On this first, excise duty has to be levied. Let's say 10%, 1 lakh. Now this car is being sold now, so VAT also has to be levied. On VAT also 10% now VAT 10% is levied on, not on this 10 lakhs. It is levied on 11 lakhs. When you are levying tax on 11 lakhs, even on excise duty you are levying tax once again. Even on excise duty you are levying tax once again. So it will be a tax on tax, which leads to cascading. You understand now? So for example, VAT will be levied on the value that was included excise duty. Next, ITEC was broken as goods moved from one state to another, resulting in hidden cost for their business. This is nothing but interstate. One state to another, na, it is nothing but what? Interstate. Whenever there is interstate, previously CST is levied, na, CST, central sales tax. That central sales tax is not given as ITC. If it is not given as ITC, then it's a problem only, no. That will become cost of you, and it will form part of your hidden cost and all. That is one problem. Next, further, pre-GST, there were tax nakas at every interstate border. Tax nakas, na, there used to be some checkpoints and all. They used to check. Okay, so all the vehicles going there have to stop there, and it needs to be checked there. So every truck has to halt there. They need to carry those documents and need to physically get those documents signed, and the goods, if at all in sample basis, they'll even check the goods as well, which takes 3-4 hours of time. Now it will create bottleneck. What is called bottleneck? Sir, if you see, look at this water bottle. This bottle neck is less compared to the bottle size. So once, if I remove the cap also, water will not come so fast, because the neck here is so little small now. That's why that is called as what? Bottleneck. So there was tax knockers. Because of this tax knockers, it will take time for them to move, which is creating a bottleneck. They cannot go like that. Next, because of this bottlenecks and all, the logistics sector remained inefficient, and it adversely affected their business. Logistics sector got affected, sir. Logistics, not transport industry, got affected because their travel time increased. Okay, and they need to wait so many hours there, which is inefficient only. It's a cost to the transport industry only. Next, every state effectively a distinct market for the industry as well as customer. What does it mean? Every state, sir, it acted as a distinctive market. I mean, since on interstate sale you are not eligible to get IDC, you are not treating the whole India as one nation. You are treating your state as only your market, because if it is sold to other states and all, that fellow will not get IDC, so anyhow he will not buy. And even the procedures, laws will also change from state to state. So that's why you are doing business only within your state. So it has made a restriction on the market. Every state was effectively a distinct separate market for the industry as well as consumer. Next, industry's choice of locating factory. When a company or when an industry wants to start a factory or warehouse, it was heavily influenced by the tax regime than pure business consideration. Sir, I mean, since there are so many taxes and so many laws, the businessman, when he wants to start a factory, he's not checking about manpower availability or raw material availability. More than this, he's checking on tax compliances. What is the tax structure here? What is the rules here? What is the law here? So his focus is not just on the resources. His focus is more on the tax law. Wherever the tax law is convenient, there he is starting business, even though he doesn't have proper resources. You understand now? But now if you see in GST across India, one single law. So wherever I start a business, the same law. So I'll be bothered more about what? More about where the resources are there, where the raw material is available, where the manpower is available, that I will be checking. So this has These are the problems which were there, or limitations in the pre-GST era which were encountered by indirect taxes. You understand, right? Okay, excise duty on manufacture of excise duty on manufacture. State excise duty is levied on alcohol and drugs, whereas central excise duty is levied on manufacture of goods except alcohol and drugs. Next, we need to understand about petroleum products, sir. What are called petroleum products? Why we need to discuss about petroleum products now? Petroleum products are currently not under the scope of GST. They will be brought into the scope of GST only from the date the council recommends. Only from the date council recommends. What are those? High speed diesel oil, crude petroleum, motor spirit, aviation turbine fuel, natural gas. The code we have is HPMAN. High speed diesel oil, petroleum crude, motor spirit, aviation turbine fuel, natural gas. These are the goods and such services which are out of the ambit of GST. Okay, and even alcoholic liquor is currently out of GST, because on alcohol liquor, state government will only levy state excise duty. State government will only levy state excise duty. These are the goods and services which are the out of ambit of GST. Okay, now let's go further. Now we are into the concept of features of indirect taxes, not GST, features of indirect taxes. This also there in MTPs and the past exam questions related one, this one also. So I'll discuss there only. Benefits, constitution. Analyze the basic reasons to impose taxation. Understand this question, sir. What is the reason for levying taxes, and also state the features of levying indirect taxes? Why a tax has to be levied, and what are the features of indirect taxes? The basic reasons to impose taxation is like, what is the basic reason to to levy taxation? Sir, only when tax is levied, government will have revenue. And with the revenue government will be building infrastructure like roads, street lights, okay, other welfare schemes and all. If they need to provide healthcare, electricity, police stations, military, okay, all these, if it needs to be run, then government needs money. So for the purpose of generating that money, government will levy taxes to provide basic facility for every citizen of country. Whatever money is received by the government from taxation is spent for the welfare of the citizens. Some of the services provided by the government, what welfare? Healthcare, government hospitals, electricity, government is providing at some places for subsidy as well. Then roads, education system, government schools they are running, free houses for the poor, water supply, police, firefighters, judiciary, court system, disaster relief, okay, and taking care of bridges and other things of public welfare. So for this reason, to have money for doing all these things, they need to levy something as tax on us. That money which they generate by levying tax will be used for providing this kind of person, and even to finance multiple governments, because if local authorities may not have adequate funds to discharge their functions, then central government will give some amount as grants to local authorities to perform their functions and all. So all the local governments of the state, like village panchayats, block panchayats and municipal corporation, receives funds from the finance commission. This will be given by finance commission. There's something called finance commission which tells like how the government has to spend money. Okay, so based on that recommendations, central government will give money to these local authorities as well. Next, and even protection of the life. The taxpayers receive the protection of life and wealth. Just because, okay, we are paying tax now, so what is the benefit we are getting now? The government is protecting you and your properties by way of police people and all. Okay, taxpayers receive the protection of life and wealth from the government in case of external aggression, internal armed rebellion, or any other situation where any exploitation, riots are happening, then government will protect you. Okay, the police force will come and protect you. So that is the reasons for levying taxation. So if you want those, then obviously you need to pay tax. So you don't say always like what country is giving me. Country is giving you roads, country is giving you infrastructure, country is giving you that security. Yes, some places there is breach, there are some irregularities in that, but at large it is giving you security. Okay. Now, what are the features of indirect taxes? The features of indirect taxes, features na qualities, characteristics kind of. Okay. Sir, I'm not discussing this in my material. I'm discussing in mock test papers only. Even for my students in EVO batch also, here in our campus also. At last, when I took EVO batch, I explained from this only because I want to make sure a student should get more marks. Okay, maybe by writing those summarized answers. If I tell summarized answer, you also maybe remembering it in a summarized way, and you're writing less than that what of the exam, less than that of what examiner expecting. So you're ending up with getting 3 and 4 marks only. So that's why I'm explaining from here. Put some effort. Yes, it will be little tough because you know concept, but you cannot write the sentences properly. So put time, listen to the class patiently, take your time, download this PDF, read it for 3-4 times, then you'll have that comfort. 14 marks, sir, you cannot leave that outrightly. 14 marks, you should spend hardly 2 hours if you spend now 14 marks in your hand. You understand? Features of indirect taxes. This is the tax on goods and services. Indirect tax is levied at the time of supply or manufacture or purchase or sale or even import or export. Further, it is also levied on supply. So first thing, it is no difference like good and service, levied on both goods and service, and at multiple places, multiple stages, on manufacture or on purchase. So not GST, the previous taxes on manufacture excise duty, on purchase or sale sales tax, on import and export customs duty. So like that, indirect tax is levied on goods and services at different places. Okay. Next, burden. I already said it, the differences only. Seller is responsible to pay tax to the government. So whenever you buy any goods, you are paying the good money and tax money to the seller. You are not paying tax directly to the government now. So it's the responsibility of seller to deposit the tax with government, whereas the ultimate burden of the such tax is paid by buyer. So the tax being indirect tax paid by the seller shall be recovered by the seller from the buyer. Thus one can say that burden of indirect tax is shifted from the seller to buyer and ultimately borne by the consumer of such goods and services. One can say that burden of indirect tax is shifted from seller to buyer and ultimately borne by consumer of such goods or services. Next, inflationary in nature. Why inflationary? Why inflationary? Na? Sir, let's say for example, if the price of good is 100, sir, then the seller will sell it for 100. But if there is indirect tax, he'll levy indirect tax at a rate of 10%, then he'll add 10 and he'll collect how much? 110. Now the price, because of indirect taxes, it became 110. Otherwise it is only 100. Na? So because of these indirect taxes, the prices are increasing. When there is increase in price, it leads to inflation. Inflation is nothing but increase in prices. So indirect taxes leads to inflation. The cost of goods and services increases due to levy of indirect taxes. Thus, indirect taxes promote inflation. Next, social welfare. How indirect tax creates social welfare, sir? Indirect tax on alcohol and on tobacco products will be levied at a high rate, sir. 80%, 90%, 100%, like that. The tax rates will be there on alcoholic liquor and on this tobacco and all. So on this high tax rates are levied. Once the high tax rates are levied, their price will go high and the consumer cannot buy these products. They are not affordable to him. Since they are not affordable, he'll stop consuming them. That's the government logic. See, if they increase these prices by way of levying more taxes, they will not be affordable to the consumer. So he'll stop consuming them. That's what government is feeling. So they are saying like, since the price increasing, demand will come down, which will lead to welfare of the society. It is a useful tool to promote social welfare by checking the consumption of harmful goods or sin goods through higher rate of tax. So they are saying like they can reduce consumption by levying higher taxes. Next, wider tax base. Wider tax base na, wider. So many goods and services are available under indirect taxes, sir. So there is a lot of scope. So many goods and services. Here in front of me itself, there are some 50 goods here, sir. My tab, connector, cables, water bottle, then the mic which we use, laptop, keyboard, computer, camera, the lights, air conditioner, fridge, and even the refrigerator, in the fans, lights, so many things are there, sir. So there's wide base. Majority of goods and services are leviable to indirect tax with very low threshold limits. So the tax base is much wider in case of indirect tax in compared to direct tax. So the base is so wider. Next, regressive in nature. Regressive in nature, now what? There is no difference between rich and poor here. You are rich. Okay, let's say, you know, Anant Ambani, rich guy wedding. Anant Ambani, when he buy a chocolate to give as gift to his wife, he is rich guy only, na. We know how rich his wedding is happened and all. He's son of Mukesh Ambani and all. If he buys a dairy milk chocolate, on that same tax rate. I buy a dairy milk chocolate, I don't have wife, don't worry. If I buy a dairy milk chocolate, on that also same tax rate. Some poor guy, some rickshaw guy purchased a dairy milk chocolate, same tax rate. So there is no difference between rich, middle class, poor and all. All person, rich and poor, will bear equal wrath, equal rate of tax. Wrath na rate of tax. Okay, or service consumed by them irrespective of their ability. In other words, indirect tax does not create any difference between rich and poor. Poor people also required to pay equal percentage of tax on certain goods and services. Thus it may increase the disparity between rich and poor. If same tax is levied na, then it will increase the gap between rich and poor. Okay, next, no pinch. No pinch na. No pinch means the, sir, you understand, direct tax na, if you come in front of me, if I slap directly na, you feel the pinch and you'll feel angry out towards me. Indirect tax na, I'll come towards your back and hit hard from your back and I'll somehow hide. You'll not find, you'll have pain but you'll not feel. Okay, that one. Or in other way, sir, if I'm getting some 30 lakh rupees as salary, and on that 30 lakh rupees, if I need to pay income tax of 8 lakhs or 9 lakhs, I feel like, hey, out of my 30 lakh salary, 8 lakhs 9 lakhs is going for tax only, I feel. You understand? But if I am buying a 30 lakhs worth car, in that 15 lakhs going for a tax only. Out of 30 lakhs, 15 lakhs, either RTO or the GST or cess, 30 lakhs car, 15 lakhs is going for a tax only. But you will not realize that. You understand? So pinch you feel in direct tax, pinch you don't feel in indirect taxes. Seller does not pursue direct pinch of tax as it is recovered by him from the buyer and then he is paying to the government. On the other hand, since it is inbuilt in the price of the goods, the ultimate payer paid without knowing that he is paying tax to the government. Since 30 lakhs will say the total price, including tax and all will tell now. So buyer also will not feel like he is paying taxes. Seller anyhow he collect from buyer now, he will also feel the pain of paying taxes. So like that, there is no pinch on both seller and buyer. So these are the reasons to impose taxes and features. What are the features, sir? It is levied on both goods and services. The burden will always be shifted by seller to the buyer. Inflationary in nature, indirect taxes are inflationary in nature. Because of them, the prices will increase. Social welfare, indirect tax act as the social welfare. Because of them, on alcohol and other sin goods, they levy high tax rate, which reduces their consumption. Wider tax base. So many goods and services are available here. So there is lot of scope to levy taxes. Regressive in nature. Rich and poor, same rate. No pinch at all. Seller will recover from buyer, so he will not have pain. Buyer thinks like the price itself is that amount, so he will not feel like paying taxes, so he will not also not have that pinch. You understand? This is the reasons, features of indirect taxes. Okay. Now, evaluation of GST, you should understand, sir. Evaluation of GST, na, federal structure and all I said. The problem regarding introducing GST is, okay, the problem regarding in GST is like, the problem in introducing GST is like, It's okay. 1 minute. I'll come back to the Article 246. Article 246 of Article 246 in that seventh schedule. This seventh schedule consists of three lists. This already you might know: union list, state list, concurrent list. Okay, this union list, state list, concurrent list will only give the power to union and state governments to frame law first. To frame law. Once they frame law, then law gives the power to levy taxes. So Article 246 is the power source to levy taxes. Article 246 gives the authority to union and state government to levy taxes. The seventh schedule of Article 246 contains three lists. What are those three lists? Union list, state list, concurrent list, which explains the matters on which central government and state government have authority. So they will explain the matters on which central and state government have authority. Now, GST is something unique, sir. The GST which we are following is like dual GST model. Dual GST model means what? On a single transaction, central government will levy tax, state government will also levy tax. Central government will levy tax, state government will also levy tax. So central na CGST, state na SGST, both will levy tax. So Article 246 is a new article introduced which gives the power to both central and state governments to frame law with respect to GST. So don't go and search in union list, state list. You will not find GST there. And don't think like if there is no power in Article 246, how GST has came. For framing laws with respect to GST, a new article has been introduced, Article 246A. Article 246A grants power to central and state governments to frame laws with respect to GST. Then Article 269A. It states that GST on interstate trade. Sir, again I said transactions are of two types. What are those two types, sir? Intrastate and interstate. What are those two types? Intrastate intrastate 1 lakh. On this what we need to levy? CGST or SGST. If it is an union territory, then you levy UTGST in the place of SGST. Example 9%, 9%. 9,000, 9,000. So total 1,18,000. This is what intrastate na, like this. If it is interstate, if it is what? Interstate, the same value and taking 1 lakh rupees, then instead of CGST and SGST, IGST will be levied. IGST will be levied 18,000. So total from the customer, the amount collected is same 1,18,000 here also 1,18,000. But the point, sir, if you understand, this 9,000 will go to central government, this 9,000 will go to state government. When if it is IGST levied, there is a question to whom this IGST revenue will go. This IGST revenue 18,000 will go initially to central government only, but central government will distribute this half of to central government will take 9,000 and the other 9,000 will be given to state government only. Will be given to state government only. States are not believing. Will you? What if you don't share subsequently? Central now it is saying like I'll give 9,000. Maki kasam, mother promise I'll give 9,000. But what if they don't share subsequently? So that's why they introduced a provision in Article 269A states that GST on interstate trade shall be levied and collected by central government. Such taxes collected will be distributed between central and states. Then Article 366. Article 366 defines GST. What is GST? GST means any tax on supply of goods, services or both, except on the supply of alcoholic liquor for human consumption. It's a tax on supply of goods, services or both, except on the supply of alcoholic liquor for human consumption. Except on alcoholic liquor for human consumption, they levy GST. Is a tax levied on supply of goods, services or both, except on alcoholic liquor for human consumption. Next, it is about GST Council. Why councils are here? Sir, understand the hierarchy here, sir. There is something called council. This council consists of members of central government and state government members. Okay, they'll take a decision first. They'll take decision, but this decision will be given as a recommendation The decision taken by council will be given as a recommendation to central government and state governments. Why? Because the power to frame law is with only central and state government, not with council. So central and state government, after receiving those recommendations, they'll frame laws or rules. These rules or laws framed will be implemented, has to be implemented by someone. That implementation will be done by CBIC. CBIC means what? Central Board of Indirect Taxes and Customs. And they will implement with the help of GSTN. GSTN is nothing but what? Goods and Service Tax Network. Understand these two full forms, sir. CBIC, Central Board of Indirect Taxes and Customs. GSTN, Goods and Service Tax Network. Fine. So council is the highest one, but it cannot frame law. So that's why the decision which they take will be given to the government as recommendations. Those recommendations will be made as law by central and state governments, and the law framed will be implemented by CBIC and GST. Got it? Okay. So now council related, sir, I am not discussing here because we have this in MTPs as well. So I'll go there and we'll discuss there. GSTN is there. Enumerate the provisions relating to constitution and functioning of GST Council. So they're asking us to tell relating to the constitution and functioning of GST Council. Who will constitute GST Council? The GST Council will be constituted by President of India, which is a joint forum. Joint forum, it consists of both central members as well as state members. So GST Council is constituted by President of India, which is a joint forum of both central and states. It has Union Finance Minister who will act as chairperson, and the Union Minister of State who is in charge for of revenue of finance. Assume like as the Deputy Finance Minister. He is also a member. Then Minister in charge of finance, taxation, or any other minister nominated by each state. From every state finance minister. Okay, all this one. So if you see, there is one chairman, one member, one chairperson, and one member from central. So central 2 members. From state, 28 plus 3 union territories which are also to be treated as states. So total 31. So total how many members, sir? 33 members will be there in council. The members of the council which were referred above shall choose one among themselves to be the vice chairperson. Sir, here these 3. I mean from state governments, one person will become vice chairperson of the council. Next, the goods and GST shall make recommendations to the union and the states on the matters mentioned here. They will be giving recommendations on what? The taxes, cess and surcharge which are levied by central and state governments to be subsumed into GST. So they gave recommendations on the taxes which need to be subsumed into GST. Next, the goods and services that are subject to exemption. So what are to be exempted in GST law or GST time? That will also be mentioned by council. Next, the model goods and service tax law principles of levy, apportionment of GST, and how it will be apportioned between central and state government, the place of supply provisions, all those. Okay, the council will look after all these things, like whether it is FCM or RCM, how the GST will be distributed between central and state. So those kind of principles, okay, the framing related issues will also be taken care by council. Next, the threshold limit. Recommendations on threshold limit of turnover for which goods and services may be exempted from registration or from taxation. Sir, in registration chapter, you will understand like when your turnover exceeds 20 lakhs or when your turnover exceeds 40 lakhs, you are required to register. So those threshold limits will be given or will be recommended by whom? GST Council. The rates, including floor rates with bands of goods, nothing but the tax rates, sir. They'll give recommendations on tax rates, and even in certain cases special rates. Special rates will be given for a specified period to generate some additional resources in case of calamity or disaster. If they need some additional funds, then how those special rates will be recovered and all that also will be recommended by council. And with respect to special category states, how the special category states, which has to be there in special category states, what are the special provisions that should be there for special category states, related to them recommendations will be given. And with respect to any other matter, council may decide. Okay, any other matter council may decide, they can give recommendations. Okay, and even the council will recommend the date from which the petroleum products will be taxed. Petroleum products will be brought into GST. The date from which petroleum products will be brought into GST. What are called petroleum products? HP-MAN, high-speed diesel oil, petroleum crude, motor spirit, aviation turbine fuel, and natural gas. So regarding them, from which day they can be brought into GST, that can be recommended by council. Next, the other things. Okay, out of the total 33 members, half 50% of the one half of the total members of the council shall constitute a quorum. Quorum na, the minimum count of members to be present in a meeting. Out of 33, that means out of at least 17 members should present. Only when 17 members present, then it is a valid meeting. Then it is a valid meeting. Every decision of the GST council shall be taken at a meeting by a majority of. So to take a to decide in a meeting by the council, not less than 3/4 of the weighted votes of the members present and voting. So out of all of them, at least 3/4 should be in favor of the decision. 3/4 should be in favor. So now, does central and state governments will have equal voting power? No. The central government will have a voting power of 1/3, whereas state governments altogether will have 2/3. State governments will altogether will have 2/3. Okay. So now to take a decision from council, 3/4 of the vote should be in favor. 3/4. This we know, sir, all these things, but the sentences were kept in a different way. So if you study this and try to write the answer in this way, okay, just to get more marks, sir, what I am trying to do is, like, since we know 2 questions are coming, if our prediction goes well and considering the trend and all, 2 questions are coming. Why to take risk? Just write as per their requirement only, na. If it is one question, I might not stress you so much. You read this fine and write whatever the content you remember there. Right? You'll get some 3 and 4 marks. Fine. Like that I used to talk. But now it's not the case, sir. 14 marks. You cannot take choice. Okay. And even council shall establish a mechanism to adjudicate. Adjudicate not to decide any dispute between government of India and state. Government of India and any state on one side and another states. Few states and central government one side, other state governments another side. And between 2 or more states within the states itself, how those disputes has to be solved and all will be, the council will only establish a mechanism for that. So these are the constitution of council and its functioning. See, there are some points which are quite new. Even not only my class, sir, even if you listen some other faculty class also, I know nobody will not discuss this much thing in the initial days when we are discussing GST and all. But now it is required, sir. So put that effort. Okay. So now we'll be into the concept of GST. GST is a value added tax. GST is a value added tax. Value added tax means GST, if you remember that manufacturer, wholesaler, retailer example, GST, since ITC concept is there, there's a concept of input tax credit. Even though it looks like the full amount is being taxed, let's say, sir, manufacturer, wholesaler, retailer, 900 cost, markup 100, selling price 1000. On this GST at a rate of IGST at a rate of 18%, it is 180. So total it is 1180, right? But since it is an inward supply to wholesaler, wholesaler is eligible to get ITC. He'll get ITC of how much? 180 rupees. Now the cost will be only 1000 rupees, and markup 100, okay, it will come to 1100. Now if 1100 is on 1100, if tax is levied, it would be 198. Even though it looks like 198, but effectively the tax paid is from this 198 will adjust ITC. Then effectively the tax paid is only 18 rupees, which is nothing but on the value addition. This value addition into 18%, if you do also, it is what 18 rupees only. That is what you are paying. So that's why effectively in GST only the value added is getting taxed. So that's why GST is a value added tax levied on manufacture, sale, consumption. It offers continuous chain of credits. Okay, there is no difference between manufacturer, wholesaler, retailer. Everybody is eligible to get the credit. Next, supplier at each stage. Every supplier is available to avail ITC. Next, there is no tax on tax because only value added is getting taxed now. So there is no cascading effect. There is no tax on tax. And then GST is a destination based tax. What does it mean by destination based tax? Means, see, supplier is in Maharashtra, whereas recipient is in Karnataka. Supplier is in Maharashtra, recipient is in Karnataka. The supplier supplied goods to this recipient in Karnataka. Since both are in two different states, it is what? Interstate. It is an interstate state. So which tax? IGST is levied. Let's say goods worth 1 lakh rupees. On this the IGST is levied 18,000. So total 1,18,000. Now this recipient will pay to the supplier 1,18,000. Till now it's clear now. Now this supplier has to pay 18,000 rupees as tax. So he paid tax 18,000 to government. Now the question is, to whom this 18,000 revenue will go? This 18,000 revenue IGST will be collected by central government. But what IGST will do? I mean central government will do. Out of this, they half 9,000 will be taken by central government. Another 9,000 will be given to state government. So here there are two state governments involved. One is Maharashtra and the second one is Karnataka. To which state? To which state the tax revenue will be distributed? So this 9,000 will not go to Maharashtra. This 9,000 will be given to destination state where the goods ultimate destination is there. It is there in Karnataka. Na? So this 9,000 will go to destination. Destination means what? Karnataka. Destination state, there is nothing but what? Karnataka. Okay. Next, framework of GST. This we know, dual GST. In India, I mean, the GST which we are using is a dual GST model. It consists of both CGST and SGST. Okay, the examples. And it offers seamless flow of credit and all. Next, GST common portal. GST common portal, it is nothing but about the GSTN, Goods and Service Tax Network. So you should understand why GSTN is needed. Sir, since GST is a completely tech-based, I mean IT-enabled act, everywhere, wherever it is possible, they have linked IT, information technology. So to reduce the compliance burden and to have proper check regarding the tax payments and all, they have introduced IT. So to maintain these IT systems and to act as a clearinghouse, because this IGST revenue collected has to be distributed between central and states. So this distribution and all has to be done properly by a person. So for that purpose, to enable and to monitor these IT related hardware, software related activities and to distribute the revenues between central and state governments, they want one person who will act independently. So that's why they started a person called GSTN, Goods and Service Tax Network. So this question is also there in MTP, sir. So that's why I'll go and discuss it from the MTBs only. GSTN. See, write a short note, meaning, functions and salient features on GST network. GSTN, Goods and Service Tax Network, is a common platform. I said it's a common platform. What does it mean by common platform? Everybody in the GST, it is a common platform for all the stakeholders, either a taxpayer, department, government. So for all of them, it's a common platform which act as a clearinghouse and verify the claims and inform the respective government to transfer the funds. Okay, so and it will give instructions to the governments and also how the funds has to be transferred, what funds they are going to receive. This is possible with the help of a strong IT infrastructure. Okay, so accordingly, since a strong IT infrastructure is required, government has established a common GST electronic portal, which is a website managed by GSTN. So GSTN manages a website even called GSTN, okay, for the taxpayers, and it acts as a common IT infrastructure for the central and states. And GST is started as a non-profit organization. It is a special purpose vehicle. Special purpose vehicle na, its job is not to do any other activity. Its only objective is to monitor and to make it better the implementation of GST, to reduce the compliance burden. Only those are the objectives of GSTN. The functions of GSTN. The functions of GSTN are like, it facilitates registration. Sir, understand, it does not grant registration. It facilitates registration. Facilitating now, it helps us in getting registration. Instead of you going to the register office, GST offices and all, through online from your place itself, you can apply for registration. So it will facilitate registration. Next, it forward the returns and to central and state authorities. So when you file a return, that return related data information will be automatically transferred to the central and state authorities. Next, computation and settlement of IGST. The IGST will be computed and will be settled between the governments, and even matches the tax payment details with bank network. When I pay the tax amount, whatever the money which got deducted in my account shall be reflected in the GST portal, so that matching will be carried out by them. And they provide various MIS report. It's not NIS, it is MIS reports. MIS means management information system reports. Management information system reports na, these are certain summary reports related to various data. These reports helps the government in taking various decision making and all. Let's say for example, how much are the total iron sales that are occurred in a particular month for state wise. So then it would be easy for them, for the council or the government, to decide whether they want to reduce the GST rates on iron or not. So for that purpose, these MIS reports will serve. So they provide MIS reports to the central and state governments, and they provide analysis on taxpayers profile. So what does this analysis? Let's say I'm a taxpayer, the GSTN will analyze me and will have certain trends. Like let's say in 2023, I have sales in November month 5 lakhs. Whereas in 2022 November, I have 4.5 lakhs. Whereas in 2024 November, I'm saying like I'm having sale of only 1 lakh. Then automatically it analyzes my profile and triggers me, stating like, for the past 2 years in November month, you are having 4.5 and 5 lakhs. But this year you are having 1 lakhs, means there is some significant differences. So they want to cross check, or they want to identify me, or they want to cross check whether any tax evasion is happening or not. So like the taxpayer's profile will be analyzed by the GSTN and running the matching engine. Matching engine, so the matching engine is nothing but when a supplier files GSTR1, then what the portal will do, sir? The portal, GSTN maintained portal, will automatically reflects the credit to corresponding buyer, will automatically reflects, credit will be auto populated. So this auto population concept is there now, that when supplier files a return, then the corresponding recipient will automatically gets his credit. That is called as matching concept. So that would be maintained by the GSTN. Okay, so understand, sir. To make it simple, GST is a common platform which is needed for all the stakeholders. It acts as a clearing house for verify the claims and settle the revenues between the respective governments. So this clearing house act as a common platform. All this is possible only when they have a strong IT infrastructure. That's why government has established this GST electronic portal, a website which is maintained by GSTIN. The various functions of GSTN are like, it facilitates registration, it forwards the returns to central and state governments, it computes and settles the IGST revenue between central and state, and matches the bank details with bank network, matches the payment details with bank networks, provide various MIS reports to central and state authorities for decision making, and provide analysis on taxpayers profile, and even runs the matching engine. Okay, salient features are, it was incorporated in March 2023 as section 25 company, as section 25, sir. Sir, Section 25 of 1956 Act, sir. Companies Act 1956, 1956 Companies Act. That's why it is 25. In the 2013 Companies Act, it is Section 8. Incorporated in March 2013 as a Section 25 company of 1956 Act. It is a 100% government owned company with paid capital of 10 crores. Two functions as a common pass-through portal for taxpayers. It acts as a common pass-through portal for submitting registrations, filing returns, and making the tax payments. To develop back-end modules for states, the software needed for the states and all that development will also be taken care by GSTN. And Infosys is appointed as the service provider. So the actual software development is made by Infosys, but the monitoring of it is made by GSTN. So it appointed more than GST Suvidha providers. GST Suvidha providers na various IT tech companies. These providers will develop applications which will enable GST in those applications as well. You understand? This is about the GSTN. Then, so see, GSPs now goods and service tax suvidha providers, goods and service tax suvidha providers, and ASPs na application service providers. So GST has selected certain IT and financial technology companies to be called as GST Suvidha providers. It has identified what? Certain IT, information technology, and fintech, financial technology companies to be called as Suvidha providers. What they'll do? So there'll be a gap between the GST which is framed and the actual user where he is. So the GST requirements are here, whereas the user is here. So this tech gap is there. So GST is requiring the returns, the registration, everything in a IT enabled form. But whereas this user or the actual taxpayers may not be in such position. So these GSPs are certain persons who are identified by GSTN. They develop softwares and applications considering GST requirements. So they'll try to bridge the gap between the GST system and the taxpayers business environment. So GSPs develop applications to be used by taxpayers for interacting with GSTN. This facilitates the taxpayers in uploading invoices as well as filing of returns. Next, sir, next concept is about compensation cess. Why compensation cess is levied on both intrastate supplies as well as interstate supplies. Okay, 5 compensation cess, sir. Sir, due to introduction of GST, certain state governments are losing revenue. So the state governments are little bit against to the GST and all. So now central government came forward and said like, whatever the losses you suffer, such losses will be compensated by central government. Okay, till here it is fine. To compensate such losses, central government also has no funds. So that's why central government started levying another tax called as compensation cess on us. So whatever the revenue they generate by levying this compensation cess, such amount will be used to compensate the revenue lost to the state governments. This is initially kept for 5 years, then it is extended for another 4 years. So overall, it will be there for a period of 9 years. But I think it will be continuing only. So compensation cess is leviable on intrastate supplies and interstate supplies with a view to provide for compensation to the states for the loss of revenue arising on account of implementation of GST. It is levied on specific luxury products. It's not levied on all the products, sir. Only on certain luxury products like cars, high-end cars and all. And on demerit goods. Demerit goods na pan masala, tobacco. And it is levied for the first 9 years of the GST regime. Okay. So even on intrastate cess will be there. Interstate also compensation cess will be there. So these 2 points anyhow we discussed. So the last concept which we are pending here is benefits of GST. So this is the benefits of GST, sir. Both are same questions only. So I'm reading here benefits of GST. Sir, I'm reading line by line because as per the knowledge I have, you might not read these questions in this way till now. Okay, I could have explained it in 5 minutes also, the whole benefits of GST, everything from my material. But that will be something like me covering the topic only. It doesn't give you much value addition for you. So that's why I'm reading line by line and explaining as if it is like a somewhat not regular class, somewhat speedier than a regular class. So discuss the benefits of GST in respect of business, industry, central and state governments and the consumer. So they are asking benefits from the perspective of business and industry, overall business, central and state government, and even from the consumer. Okay. So he has categorized into 3 parts, sir. A, B, C. So now see, for the benefits that can be summarized for business and industry. What is the first benefit, sir? Easy compliance. Compliance na, the rules, procedures which we need to follow were made easy. How they are made easy na, majorly because of IT. So see, a robust means something like unstoppable, robust and comprehensive IT system which covers everything. It's not only strong, it covers all the aspects. So a robust and comprehensive IT system is the foundation of the GST regime in India. So it's the basic foundation. So because of this robust IT and comprehensive IT system, what happened? All the taxpayer services such as registrations, returns, payments would be available to the taxpayers online. Since all the services are made online, it makes their compliance easy as well as transparent. Not only easy, it makes transparent. So how the flow is going on, everything is visible. It made transparent as well. Next, uniformity in tax rates and structures. This also previously in the old era, like central used to levy certain taxes, state used to levy certain taxes, and even from one state to another there used to be different laws, procedures, tax rates. But now there is uniform tax rates and uniform tax structures. GST ensure that indirect tax rates and structures are common across the country, thereby increasing certainty. Like we could assume like, okay, this is what, so we could trust. Even if you change business location from one state to another, there is no problem for you. You have that certainty and ease of doing business. In other words, GST would make doing businesses in the country tax neutral irrespective of the choice of place of doing business. Sir, if you remember, we explained one point in the limitations of GST, limitations of the pre-GST era. There what we said, the businessman used to think of where the tax compliances are better. That would be his perspective rather than which place would be better to do business. But now he'll again shift to focus on like which place would be better, where the resources are available. That only will be his choice. So GST would make doing businesses in the country tax neutral irrespective of the choice of place of doing business. Next, removal of cascading. Cascading what? There is no tax on tax. How? Since in every stage GST allows or offers input tax credit. So at every stage, since input tax credit is offered, only the value added is getting taxed. Since value added is only getting taxed, there is no cascading. A system of seamless tax credit. Okay, there is no difference between manufacturer, trader. There is no difference between intrastate and interstate. Everybody will get the seamless tax credits throughout the value chain and across boundaries of states, would ensure that there is minimal cascading of taxes. So still they are not saying like there is no cascading, but there is only minimal cascading. So this will reduce hidden cost of doing business. Next, improved competitiveness. How it is improving competitiveness, sir? Because compliance came down, cascading came down. So because of all these, even the business cost will also come down. When cost come down, the business can sell products at a cheaper price, so which increases their competitiveness. So reduction in transaction costs of doing business would eventually lead to an improved competitiveness of the trade and industry. So it reduces their transaction costs because the selling price, buying price will come down. There is no hidden cost, there is no cascading and all, and there is no compliance. The compliance costs are also minimal only, so their overall cost will come down, which will lead to an improved competitiveness for the trade and industry. Next, gain to manufacturers and exporters. What is the gain to manufacturers and exporters? Sir, the gain to manufacturers and exporters are like, see, the subsuming of major central and state tax, complete and comprehensive set of ITC, and phasing out CST would reduce the cost of locally manufactured goods and service. So till now they didn't said anything new. They're simply saying like the central state tax both are subsumed into GST, so there are no multiple levies, and there is ITC allowed on both goods and services. There is no CST concept also. So because of this, what happened now? It would reduce the cost that we already discussed. It would reduce the cost. So since the cost is reduced, it will increase the competitiveness of Indian goods. I mean, we could sell them at a cheaper price. So cheaper price now we could be in the fair competition. Even in not only, so the above point is about national within the country. Now they are talking about international market also and give boost to Indian exports. So when we can sell our products at a lower price, then the foreign buyer may also prefer our goods now. So even in international market also we'll have that competitiveness and will be boosting our Indian exports. The uniformity in tax rates and procedures across the country will also go a long way in reducing the compliance cost. So these are the benefits from the perspective of industry. What are those? Easy compliance. Okay, how a robust and comprehensive IT system has the base for GST regime in India. So because of this strong, robust and comprehensive IT system, all the services are provided through online only, such as registration, returns, payments, etc. So which made the compliances easy and transparent. Next, across the country, there are no different tax rates and tax structures. Across the country, there is only the same tax rates and tax structures, which made the doing business easy. And now the businessman, instead of focusing on where the taxes or where the compliances or the tax provisions are attractive, he would check for the place which is attractive for doing business rather than for tax purpose. Next, removal of cascading effect. Here, irrespective of whether it is intrastate or interstate, whether it is manufacturer or retailer, so for everyone across the value chain, there is seamless flow of tax credits, which would ensure that there is minimal cascading. Improved competitiveness. How the competitiveness is improved? Because of reduction in transactional costs. How transactional costs got reduced? Because of minimal cascading effect, because of uniform procedures, okay, because of robust IT systems, the transaction cost has came down, which would lead to an improved competitiveness in trade and industry. The same way, it will reduce cost. Even our products in the global markets also will become competitive, so we'll grab more export orders. And even this uniformity in tax rates and procedures will also take us much more farther in reducing our compliance costs. Next, the benefits for central and state governments. What are the benefits for central or state governments? Simple and easy to administer. Multiple indirect taxes at the central and state levels are being replaced by GST. Multiple indirect taxes are now replaced by GST. So now what? Instead of maintaining multiple systems, so they could maintain a single system. So backed with a robust IT system, GST would be simpler and easier to administer all the indirect taxes of the central and states levied so far. So otherwise now for every tax there is one department, there is one kind of systems and all. There is no interconnection between the various taxation departments and all. So that would be so messy and complicated. Now that has been eliminated. Next, better control on leakage. Since there are multiple levies, I might be reporting my purchases or sales under VAT law in one way, under excise law in another way, and even in other luxury tax or any other taxes there are there in a different way. That would lead to tax leakages and all. But now GST will result in better tax compliances. Here everything is enabled or linked to IT. Due to robust IT infrastructure, compliance will get better. So, and even ITC will also go seamlessly from one stage to another chain in the valuation. So there is an inbuilt mechanism to design that whether the compliance is proper or not. Because the supplier, if he didn't file GST or one recipient will not get ITC. But previously it's not like that. So now within the system itself, they have inbuilt mechanisms like only when supplier complies with the rules, then recipient will get ITC. So such way it controls the leakages. Next, higher revenue efficiency. How GST is expected to decrease the cost of collection of tax. Sir, even to collect taxes, government will also incur some expenses on their staff, on their administration works and all. Now, since everything is IT enabled, even the officers will also act through the systems only instead of they going doing physical verifications and all. So their cost to generate tax revenue will also improve, will also reduce. So it brings overall higher revenue efficiency. And it is boosted to Make in India initiative. Make in India initiative means what? Like the goods has to be, the manufacture of goods in India has to be encouraged. So GST will give a major boost to Make in India initiative, because the goods and services can be produced in India at a competitive prices in the nation as well as international market. So what are the benefits for central and state government, sir? Simple and easy to administer. How? Because of the robust and comprehensive ID system, it would be easier for them to administer. There are no multiple taxes and multiple systems, only one thing. And better controls on leakage. How? Because of the robust ID only, again. Because of the robust ID and seamless flow of ITC, inherently within the system itself, there is an inbuilt mechanism. So, which controls the revenue leakages, higher revenue efficiency. How? The cost that would be incurred by the government to collect taxes will also come down because of this overall IT linkage in GST. Next, boost to Make in India initiative. This is something like repetitive only, sir. Because of GST, the overall costs will come down, which make the goods and services produced in India competitive in the national as well as international market. Now, as a consumer, so you are not a business person, you are not government, you are just a consumer. You buy a soap, you buy a chocolate, you buy a shirt, pant, like that. Okay, so what are the benefits for you? Single and transparent tax proportionate to the value of goods and services. Sir, previously, since there are many taxes, inherently there will be so many hidden taxes which you don't even know, that will automatically add into cost. You don't even have fair understanding of how much of that amount is going to government, how much is going to the business person. You think, like, let's say on a product, sir, sorry, raw material from Chennai purchased to Karnataka. So since it is an interstate, CST is levied. But CST cannot be taken as ITC previously. So this raw material actually 50 lakhs. On this CST 5 lakhs. Now what becomes, since ITC is not allowed, this raw material will be considered as 55 lakhs and it will go into the production process, and the overall finished good came to 1 crore. In this finished good cost 1 crore, even this CST 5 lakhs also has been included, which is not given as ITC. Now on this there is excise duty and again there is VAT. So now if you are levying excise duty and VAT, you think like only this amount. Let's say both are 10%. Now here this is 10 lakhs and here this is 11 lakhs. Only 21 lakhs is the total tax which was went to government from this transaction. But actually it is almost 26 lakhs, because you are forgetting this 5 lakhs which has been paid to government, because you cannot see that it was a hidden one. So due to multiple indirect taxes being levied by the central and state with incomplete or no input tax available at progressive stages of value addition, because of multiple indirect taxes and no ITC available, the cost of most goods and services in the country are laden, included with many hidden taxes. But under GST, there would be only one tax from manufacturer to consumer, leading to transparency of taxes paid to the final consumer, paid by the final consumer. So you'll have transparency, how much taxes you have paid overall on a product. Next, relief in your overall tax burden. How? Sir, as we already said, like there is prevention of leakages and there is cost cut down, everything. So we'll get those goods at a cheaper price as well. Because of efficiency gains and prevention of leakages, the overall tax burden on most commodities will come down, which will benefit consumers. So the overall tax rates will also come down, because previously they used to charge 20% considering revenue leakages, but now there are no revenue leakages now, so government will also make the 20 as 18%. So overall the consumer tax burden will also come down. So these are the benefits for consumers: the single and transparent tax proportionate to the value of goods. You are aware of how much taxes that have been collected from you in GST system, because everything is transparent. But in the previous taxation systems and all, you cannot find out, because there are so many hidden taxes involved in that. Next, relief in overall tax burden. Because of increase in efficiency and prevention of leakages, even the tax rates overall on majority commodities will come down, so which will reduce the burden and benefit customers. These are the benefits of GST. Sir, even if you see the 7 benefits, the same given, sir. Easy compliance, uniformity in tax rates, removal of cascading, improved competitiveness, gain to manufacturers and exporters. Now from central and state government, simple and easy to administer, better control on leakage, higher revenue efficiency. Boost to Make in India. From consumers, single and transparent tax proportionate to the value of goods and services, relief in overall tax burden. So the point is, if any material if you study except the mock test paper answer, the benefits we rate are also benefits only, but they doesn't actually coincide with these benefits. Understand, if I'm a paper evaluator, I should follow to an extent the institute given key paper to me. So I'll think like, for this much answer this fellow wrote only 5-6 points, no, then I'll not be ready to give you even 6.5 for a 7 marks question. So that's why I'm explaining in the mock test papers only. Understand? Yes, I know you feel like new at this last 13-14 days time, you feel like listening to this as new, you feel like taking this more time and all, but believe me, this is worth putting the time on this particular areas. So first questions are differences between direct taxes and indirect taxes, covered. Second questions are benefits of GST, covered. Third questions are benefits of GST. Next, constitution and functioning of GST Council, covered. Then 7 state taxes which are subsumed into GST, covered. Basic reasons to impose taxes and the features of indirect taxation, covered. Then this is not relevant for sir, but okay, let me apply and state the constitutional provisions in relation to levy and collection of goods and service tax in course of interstate. Sir, in course of interstate, what tax will be levied? IGST. So related to that, he is asking few points, sir. Goods and services and tax on supplies in the goods and services taxed on supplies in the course of interstate trade or commerce shall be levied and collected by the government of India, and such tax shall be apportioned between the union and states in the manner as may be provided by the parliament on the recommendations of council. So, let me explain you this point. On interstate, the tax will be collected by government of India. Right? You understand? On interstate, the tax will be collected by central government of India. First point. And such tax will be apportioned between union and states. In what manner? That would be the manner as provided by parliament by law on the recommendations of council. But we know this. This is what 50-50. Okay. Supply of goods and services both in the course of import shall always be deemed as supply of goods and services in the course of interstate. In the course of interstate. So imports are always what? Interstate only. The amount apportioned to the state shall not form part of consolidated fund of India. So from the, it will not form part of government of India, that fund, because that is apportioned to state, it has to be transferred to the state. Okay, where an amount is collected as IGST is used for SGST, such amount shall not form part of consolidated fund of India. If any IGST amount is used for SGST payment, such amount has to be transferred by central government to state government. Okay, so this is about interstate, sir. This is about composite supply and mixed supply, sir. Goods are packed and transported along with insurance. This is a common thing, sir. Everybody will pack and transport the goods majorly, so it is what? Composite supply only. Goods packed and transported with insurance. The supply of goods, packing materials, transport is a composite supply, and supply of good is a principal supply. Next, food supply to inpatients as advised by doctor and nutritionist. This is also a composite supply, because during the course of treatment, doctor usually suggests some food supplied. If it is supplied from the hospital canteen, then it would be treated as composite supply. It is the part of a composite supply of healthcare and not separately taxable. Further, supplies of food by hospital to patients not admitted or their attendants or visitors are taxable. That is not composite supply. Only to inpatients, if food is supplied, that would be treated as composite supply. Next, identify any issues. Sir, this one, sir, same duplication only. This question also we discussed. But see the question framing. Identify any 4 issues in the pre-GST regime which were addressed by GST law. But here they asked, like, state the difficulties, limitations in pre-GST regime in the context of indirect taxes. So pre-GST regime, the same question. Benefits, 2 questions. Sir, if you see, I have 7 8 questions, but 2 duplications. So hardly here there are 7 questions. Other than this, what additionally we study, sir? Additionally, you study compensation cess. Additionally, you study compensation cess and petroleum products. Rest all I think covered here only in these 7 questions also. So my sincere advice, don't neglect this chapter. Give that respect to the chapter which is giving 14 to 16 marks for us. We should give that minimum respect to that chapter by spending some 1.5 hour, 2 hours time, because that much weightage is there. Don't think like the chapter is little only, but the chapter is little also. They're asking 14 marks means you should understand properly and give that time. Easy pickings, easy pickings.